belong. Chapter 15. Stock selection for the enterprising investor. In the previous chapter, we have dealt with common stock selection in terms of broad groups of eligible securities from which defensive investor is free to make up any list that he or his advisor prefers, provided adequate diversification is achieved. Our emphasis in selection has been chiefly on exclusions, advising on the one hand against all issues of recognizably poor quality, and on the other against the highest quality issues if their price is so high as to involve a considerable speculative risk. In this chapter addressed to the enterprising investor, we must consider the possibilities and the means of making individual selections which are likely to prove more profitable than an across-the-board average. What are the prospects of doing this successfully? We would be less than frank, as the euphemism goes, if we did not at the outset express some grave reservations on the score. At first blush, the case for successful selection appears self-evident. To get average results at G, equivalent to the performance of the DJIA, should require no special ability of any kind. All that is needed is a portfolio identical with or similar to those 30 prominent issues. Surely then, by the exercise of even a moderate degree of skill derived from study, experience, and native ability, it should be possible to obtain substantially better results than the DIA. Yet there is considerable and impressive evidence to the effect that this is very hard to do, even though the qualifications of those trying it are of the highest. The evidence lies in the record of the numerous investment companies or funds which have been in operation for many years. Most of these funds are large enough to command the services of the best financial or security analysts in the field, together with all the other constituents of an adequate research department. Their expenses of operation when spread. Jamin, 1894. Over their ample capital, average about 1/2% a year thereon, or less. These costs are not negligible in themselves, but when they are compared with the approximately 15% annual overall return on common stocks generally in the decade, 1951 to 1960, and even the 6% return in 1961 to 1970, they do not bulk large. A small amount of superior selective ability should easily have overcome that expense handicap and brought in a superior net result for the fund shareholders. Taken as a whole, however, the all-common stock funds failed, over a long span of years, to earn quite as good a return as was shown on Standard & Poor's 500 stock averages or the market as a whole. This conclusion has been substantiated by several comprehensive studies. To quote the latest one before us, covering the period 1960 to 1968, it appears from these results that random portfolios of New York Stock Exchange stocks with equal investment in each stock performed on the average better over the period than did mutual funds in the same risk class. The differences were fairly substantial for the low and medium risk portfolios, 3.7% and 2.5% respectively per annum, but quite small for the high risk portfolios, 0.2% per ASWE annum. One pointed out in Chapter 9, these comparative figures in no way invalidate the usefulness of the investment funds as a financial institution, for they do make available to all members of the investing public the possibility of obtaining approximately average results on their common stock commitments. For a variety of reasons put their money in common funds, most members of the public whose stocks of their own choice fail to do nearly as well. But to the objective observer, the failure of the funds to better the performance of a broad average is a pretty conclusive indication that such an achievement, instead of being easy, is in fact extremely difficult. Why should this be so? We can think of two different explanations, each of which may be partially applicable. The first is the possibility that the stock market does in fact reflect in the current prices not only all the important facts about the company's past and current performance, but also whatever expectations can be reasonably formed as to their future. If this is so, then the diverse market movements which subsequently take place, and these are often extreme, must be the result of new developments and probabilities that could not be reliably foreseen. This would make the price movements essentially fortuitous and random. To the extent that the foregoing is true, the work of the security analyst, however intelligent and thorough, must be largely ineffective, because in essence he is trying to predict the unpredictable. The very multiplication of the number of security analysts may have played an important part in bringing about this result. With hundreds, even thousands of experts studying the value factors behind an important common stock, It would be natural to expect that its current price would reflect pretty well the consensus of informed opinion on its value. Those who would prefer to other issues would do so for reasons of personal partiality or optimism that could just as well be wrong as right. We have often thought of the analogy between the work of the host of security analysts on Wall Street and the performance of master bridge players at a duplicate bridge tournament. The former try to pick a stocks most likely to succeed, the latter to get top score for each hand played. Only a limited few can accomplish either aim. To the extent that all the bridge players have about the same level of expertness, the winners are likely to be determined by breaks of various sorts rather than superior skill. On Wall Street, the leveling process is helped along by the Freemasonry. It exists in the profession under which ideas and discoveries are quite freely shared at the numerous get-togethers of various sorts. That 1894. It is almost as if at the analogous bridge tournament, the various experts were looking over each other's shoulders and arguing out each hand as it was played. The second possibility is of a quite different sort. Perhaps many of the security analysts are handicapped by a flaw in their basic approach to the problem of stock selection. They seek the industries with the best prospects of growth and the companies in these industries with the best management and other advantages. The implication is that they will buy into such industries and such companies at any price, however high, and they will avoid less promising industries and companies no matter how low the price of their shares. This would be the only correct procedure if the earnings of the good companies were sure to grow at a rapid rate indefinitely in the future, for then in theory their value would be infinite. And if the less promising companies were headed for extinction with no salvage, the analysts would be right to consider them unattractive at any price. The truth about our corporate ventures is quite otherwise. Extremely few companies have been able to show a high rate of uninterrupted growth for long periods of time. Remarkably few also of the larger companies suffer ultimate extinction. For most, their history is one of vicissitudes, of ups and downs, of change in their relative standing. In some, the variations from rags to riches and back have been repeated on almost a cyclical basis. The phrase used to be a standard one applied to the steel industry. For others, spectacular changes have been identified with deterioration improvement of management. Or, how does the foregoing inquiry apply to the enterprising investor who would like to make individual selections that will yield superior results? It suggests, first of all, that he is taking on a difficult and perhaps impracticable assignment. Readers of this book, however intelligent and knowing, could scarcely expect to do a better job of portfolio selection than the top analysts of the country. But if it is true that a fairly large segment of the stock market is often discriminated against or entirely neglected in the standard analytical selections, then the intelligent investor may be in a position to profit from the resultant undervaluations. But to do so, he must follow specific methods that are not generally accepted on Wall Street, since those that are so accepted do not seem to produce the results everyone would like to achieve. It would be rather strange if, with all the brains at work professionally in the stock market, there could be approaches which are both sound and relatively unpopular. Yet our own career and reputation have been based on this unlikely fact. A summary of the Graham-Newman methods to give concreteness to the last statement, it should be worthwhile to give a brief account of the types of operations we engaged in during the 30-year life of Graham-Newman Corporation. Between 1926 and 1956, these were classified in our records as follows. Arbitrages, the purchase of a security in the simultaneous sale. 1894, of one or more other securities into which it was to be exchanged under a plan of reorganization, merger, or the like. Liquidations, purchase of shares which were to receive one or more cash payments in liquidation of the company's assets. Operations of these two classes were selected on the twin basis of A, calculated annual return of 20% or more, and B, our judgment that the chance of a successful outcome was at least 4 out of 5. Related hedges, the purchase of convertible bonds or convertible preferred shares, and the simultaneous sale of the common stock into which they were exchangeable. The position was established at close to a parity basis, i.e., at a small maximum loss if the senior issue had actually to be converted and the operation closed out in that way. But a profit would be made if the common stock fell considerably more than the senior issue and the position closed out in the market. Net current asset or bargain issues. The idea here was to acquire as many issues as possible at a cost for each of less than their book value in terms of net current assets alone, i.e., giving no value to the plant account and other assets. Our purchases were made typically at 2/3 or less of such stripped-down asset value. In most years, we carried a wide diversification here, at least 100 different issues. We should add that from time to time, we had some large-scale acquisitions of the control type, but these are not relevant to the present discussion. We kept close track of the results shown by each class of operation. In consequence of these follow-ups, we discontinued 2 broader fields which were found not to have shown satisfactory. Overall results. The first was the purchase of apparently attractive issues based on our general analysis, which were not obtainable at less than their working capital value alone. The second were unrelated hedging operations, in which the purchased security was not exchangeable for the common shares sold. Such operations correspond roughly to those recently embarked on by the new group of hedge funds in the investment company field. In 1894, both cases, a study of the results realized by us over a period of 10 years or more led us to conclude that the profits were not sufficiently dependable and the operations not sufficiently headache-proof to justify our continuing them. Hence, from 1939 on, our operations were limited to self-liquidating situations, related hedges, working capital bargains, and a few control operations. Each of these classes gave us quite consistently satisfactory results from then on, with the special feature that the related hedges turned in good profits in the bear markets when our undervalued issues were not doing so well. We hesitate to prescribe our own diet for any large number of intelligent investors. Obviously, the professional techniques we have followed are not suitable for the defensive investor, who by definition is an amateur. As for the aggressive investor, perhaps only a small minority of them would have the type of temperament needed to limit themselves so severely to only relatively small part of the world of securities. Most active-minded practitioners would prefer to venture into wider channels, their natural hunting grounds would be the entire field of securities that they felt, A, were certainly not overvalued by conservative measures, and B, appeared decidedly more attractive because of their prospects or past record, or both, than the average common stock. In such choices, they would do well to apply various tests of quality and price reasonableness along the lines we have proposed for the defensive investor. But they should be less inflexible, permitting a considerable plus in one factor to offset a small black mark in another. For example, you might not rule out a company which had shown a deficit in a year such as 1970 if large average earnings. Other important attributes made the stock look cheap. The enterprising investor may confine his choice to industries and companies about which he holds an optimistic view, but we counsel strongly against paying a high price for stock in relation to earn and ings and assets because of such enthusiasm. If he followed our philosophy in this field, he would more likely be the buyer of important cyclical enterprises such as steel shares, perhaps when the current situation is unfavorable. The near-term prospects are poor, and the low price fully reflects the current pessimism. Secondary companies next. In order for examination and possible selection would come secondary companies that are making a good showing, have a satisfactory past record, but appear to hold no charm for the public. These would be enterprises on the order of Eltra and Emhart at their 1,970 closing prices. See chapter above. There are various ways of going about locating such companies. We should like to try a novel approach here and give a reasonably detailed exposition of one such exercise in stock selection. Ours is a double purpose. Many OFA readers may find a substantial practical value in the method we shall follow, or it may suggest comparable methods to try out. Beyond that, what we shall do may help them to come to grips with the real world of common stocks, and introduce them to one of the most fascinating and valuable little volumes in existence. It is Standard & Poor's Stock Guide, published monthly and made available to the general public under annual subscription. In addition, many brokerage firms distribute the guide to their clients on request. The great bulk of the guide is given over to about 230 pages of condensed statistical information on the stocks of more than companies. These include all the issues listed on the various exchanges, say 3,000, plus some 2,500 unlisted issues. Most of the items needed for a first and even a second look at a given company appear in this compendium. From our viewpoint, the important missing datum is the net asset value, or book value, per share, which can be found in the larger Standard and Poor's volumes and elsewhere. The investor who likes to play around with corporate figures will find himself in clover with the stock guide. He can open to any page and see before his eyes a condensed panorama of the splendors and miseries of the stock market, with all-time high and low prices going as far back as 1936, when available. He will find companies that have multiplied their price 2,000 times from the minuscule low to the majestic high. For prestigious IBM, the growth was only 333 times in that period. He will find, not so exceptionally, a company whose shares advanced from to 68 and then fell back to 3.2 in the dividend record column. He will find one that goes back to 1791, paid by Industrial National Bank of Rhode Island, which recently saw fit to change its ancient corporate name. If he looks at the guide for the year in 1969, he will read that Penn Central Company, a successor to Pennsylvania Railroad, has been paying dividends steadily since 1848. Alas, it was doomed to bankruptcy a few months later. He will find a company selling at only 2 times its last reported earnings, and another selling at 99 times such earnings. 3, in most cases, he will find it difficult to tell the line of business from the corporate name. For one, us. Still, there will be 3 called such things as ETI Corp., Bakery Stuff, or Santa Fe Industries, mainly the large railroad. He can feast on an extraordinary variety of price histories, dividend and earnings histories, financial positions, capitalization setups, and whatnot. Backward-leaning conservatism, run-of-the-mind featureless companies, the most peculiar combinations of principal business, all kinds of Wall Street gadgets and widgets, they are all there, waiting to be browsed over, or studied with a serious objective. The guides give in separate columns the current dividend yields and price-earnings ratios based on latest 12-month figures, wherever applicable. It is this last item that puts us on the track of our exercise in common stock selection. A winnowing of the stock guide, suppose we look for a simple prima facie indication that a stock is cheap. The first such clue that comes to mind is a low price in relation to recent earnings. Let's make a preliminary list of stocks that sold at a multiple of 9% or less at the end of 1970. That datum is conveniently provided in the last column of the even-numbered pages. For an illustrative sample, we shall take the first 20 such low multiplier stocks. They begin with the 6th issue listed, Aberdeen MFG, company which closed the year at 10%, or 9 times its reported earnings of $1.25 per share for the 12 months ended September 1970. The 20th such issue is American Maize Products, which closed at 91.2, also with a multiplier of 9. The group may have seemed mediocre, with 10 issues selling below $10 per share. This fact is not truly important. It would probably not necessarily warn defensive investors against such a list, but the inference for enterprising investors might be favorable on balance. Before making a further scrutiny, let us calculate some numbers. Our list represents about 1 in 10 of the first 200 issues looked at. On that basis, the guide should yield, say, 450 issues selling at multipliers under 10. This would make a goodly number of candidates for further selectivity. So let us apply to our list some additional criteria, rather similar to those we suggested for the defensive investor, but not so severe. We suggest the following. 1. Financial condition. A. Current assets at least 11.2 times current liabilities, and B. Debt not more than 110% of net current assets for industrial companies. 2. Earnings stability, no deficit, in the last 5 years covered in stock guide. 3. Dividend record, some current dividend. 4. Earnings growth, last year's earnings, more than those of 1,966. 5. Price, less than 120% net tangible assets. The earnings figures in the guide were generally for those end. In September 30th, 1970, and thus do not include what may be a bad quarter at the end of that year, but an intelligent investor can ask for the moon, at least not to start with. Note also that we set no lower limit on the size of the enterprise. Small companies may afford enough safety if bought carefully and on a group basis. When we have applied the 5 additional criteria, our list of 20 candidates is reduced to only 5. Let us continue our search until the first 450 issues in the guide have yielded us a little portfolio of 15 stocks meeting our 6 requirements. They are set forth in Table 15-1, together with some relevant data. The group of course is presented for illustration only and would not necessarily have been chosen by our inquiring investor. The fact is that the user of our method would have had a much wider choice if our winnowing approach had been applied. to all 4,500 companies in the stock guide, and if the ratio for the first 10th had held good throughout, we would end up with about 150 companies meeting all 6 of our criteria of selection, the enterprise. An investor would then be able to follow his judgment or his partialities and prejudices in making a third selection of, say, 1 out of 5 in this ample list. The stock guide material includes earnings and dividend rankings, which are based on stability and growth of these factors for the past 8 years. Thus, price attractiveness does not enter here. We include the S&P rankings in our table 15-1. 10 of the 15 issues are ranked B average, and 1 American Maize is given the high rating of A. If our enterprising investor wanted to add a 7th mechanical criterion to his choice, by considering only issues ranked by Standard & Poor's as average or better in quality, he might still have about 100 such issues to choose from. One might say that a group of issues of at least average quality, meeting criteria of financial condition as well, purchasable at a low multiplier of current earnings and below asset value, should offer good promise of satisfactory investment results. Table, the Fir 6 EQ, Aber Albalbe, Ali, MMR, A. Single criteria for choosing common stocks. An inquiring reader might well ask whether the choice of a bet than average portfolio could be made a simpler affair than we have just outlined. Could a single plausible criterion be used? 2. Good advantage, such as a low price earnings ratio or a high div, idem return, or a large asset value, the 2 methods of this sort that we have found to give quite consistently good results in the longer past have been A, the purchase of low multiplier stocks of important companies such as the DJI list, and B, the choice of a diversified group of stocks selling under their net current asset value or working capital value. We have already pointed out that the low multiplier criterion applied to the DJIA at the end of 19 worked out badly when the results are measured TOMID 1,971. The record of common stock purchases made at a price below their working capital value has no such bad mark against it. The drawback here has been the drying up of such opportunities during most of the past decade. What about other bases of choice? In writing this book, we have made a series of experiments, each based on a single, fairly obvious criterion. The data used would be readily found in the Standard & Poor's Stock Guide. In all cases, a 30% stock portfolio was assumed to have been acquired at the 1968 closing prices and then revalued at June 30, 1971. The separate criteria applied were the following as applied to otherwise random choices. 1. A low multiplier of recent earnings, not confined to DJIA issues. 2. A high dividend return. 3. A very long dividend record. 4. A very large enterprise as measured by number of outstanding shares. 5. A strong financial position. 6. A low price in dollars per share. 7. A low price in relation to the previous high price. 8. A high quality ranking by Standard & Poor's. It will be noted that the stock guide has at least one column relating to each of the above criteria. This indicates the publisher's belief that each is of importance in analyzing and choosing common stocks. As we pointed out above, we should like to see another figure added, the net asset value per share. The most important fact that emerges from our various tests relates to the performance of stocks bought at random. We have tested this performance for 330 stock portfolios, each made up of issues found on the first line of the December 31st, 1968 stock guide, and also found in the issue for August 31st, 1971. Between these two dates, the S&P composite was practically unchanged, and the DJI lost about 5%. But our 90 randomly chosen issues declined an average of 22%, not counting 19 issues that were dropped from the guide and probably showed larger losses. These comparative results undoubtedly reflect the tendency of smaller issues of inferior quality to be relatively overvalued in bull markets, and not only to suffer more serious declines than the strong issues in the ensuing price collapse, but also to delay their full recovery, in many cases indefinitely. The moral for the intelligent. 894. Investor is, of course, to avoid second quality issues in making up a portfolio, unless for the enterprising investor are demon. Strable bargains. Other results gleaned from our portfolio studies may be summarized as follows. Only 3 of the groups studied showed up better than the S&P composite, and hence better than the DJI. Viz. 1. Industrials with the highest quality ranking, A. These advanced 91% in the period against a decline of 2.4% for the S&P Industrials and 5.6% for the DJI-A. However, the 10 public utility issues rated a declined 18% against a decline of 14% for the 55 stock S&P Public Utility Index. It is worth remarking that the S&P ranking showed up very well in this single test. In every case, a portfolio based on a higher ranking did better than a lower ranking portfolio. 2. Companies with more than 50 million shares outstanding showed no change on the whole, as against a small decline for the indexes. 3. Strangely enough, stocks selling at a high price per share over 100 showed a slight 1% composite advance. Among our various tests, we made one based on book value, a figure not given in the stock guide. Here we found, contrary to our investment philosophy, that companies that combine major size with a large goodwill component in their market price did very well as a whole in the 21-2-year holding period. By goodwill component, we mean the part of the price that exceeds the book value. Our list of goodwill giants was made up of 30 issues, each of which had a goodwill component of over $1 billion, representing more than half of its market price. The total market value of these goodwill items at the end of 1968 was more than $120 billion. Despite these optimistic market valuations, the group as a whole showed a price advance per share of 15% between December 1968 and August 1971, and acquitted itself best among the 20-odd lists studied. A fact like this must not be ignored in a work on investment policies. It is clear that, at the least, a considerable momentum is attached to those companies that combine the virtues of great size, an excellent past record of earnings, the public's expectation of continued earnings growth in the future, and strong market action. Over many past years, even if the price may appear excessive by our quantitative standards, the underlying market momentum may well carry such issues along more or less indefinitely, naturally. This assumption does not apply to every individual issue in the CAT. Eagery, for example, the indisputable good, will leader IBM moved down from 315 to 304 in the 30-month period. It is difficult to judge to what extent the superior market action shown is due to true or objective investment merits and to what extent to long established popularity. No doubt both factors are important here. Clearly both the long-term and the recent market action of the goodwill giants would recommend them for a diversified portfolio of common stocks. Our own preference, however, remains for other types that show a combination of favorable investment FS tours, including asset values of at least 2/3 the market price. The tests using other criteria indicate in general that random lists based on a single favorable factor did better than random lists chosen for the opposite factor, e.g. low multiplier issues had a smaller decline in this period than high multiplier issues, and long-term dividend payers lost less than those that were not paying dividends at the end of 1968. To that extent, the results support our recommendation that the issues selected meet a combination of quantitative or tangible criteria. Finally, we should comment on the much poorer showing made by our list as a whole as compared with the price record of the S&P composite. The latter is weighted by the size of each enterprise, whereas our tests are based on taking one share of each company. Evidently, the larger emphasis given to giant enterprises by the S&P method made a significant difference in the results, and points up once again their greater price stability as compared with run-of-the-mine companies. Bargain issues, or net current asset stocks in the tests discussed above, we did not include the results of buying 30 issues at a price less than their net current asset value. Their Sun was that only a handful, at most, of such issues would have been FO stuck, found in the stock guide at the end of 1968. But the picture changed in the 1,970% decline, and at the low prices of that year, a goodly number of common stocks could have been bought at below their working capital value. It always seemed, and still seems, ridiculously simple to say that iPhone can acquire a diversified group of common stocks at a price less than the applicable net current assets alone. after deduct Ingal prior claims and counting as zero the fixed and other assets. The results should be quite satisfactory. They were so in our experience for more than 30 years, say between 1923 and 1957, excluding a time of real trial in 1930 to 1932. Has this approach any relevance at the beginning of 1971? Our answer would be a qualified yes. A quick run over of the stock guide would have uncovered some 50 or more issues that appeared to be obtainable at or below net current asset value, as might be expected. A good many of these had been doing badly in the Diffie cult year 1970. If we eliminated those which had reported net losses in the last 12-month period, we would be still left with enough issues to make UPA a diversified list. We have included in table 15-2 some data on 5 issues that sold at less than their working capital value at their low prices of 1970. These give some food for reflection on the nature of stock price fluctuations. How does it come about that well-established companies whose brands are household names all over the Cown Try could be valued at such low figures at the same time when other concerns with better earnings growth? Of course, we're selling for billions of dollars in excess of what their balance sheets showed. To quote the old days once more, the idea of goodwill as an element of intangible value was usually associated with a trade name. Names such as Lady Pepperell and Sheets, Jansen N, swimsuits, and Parker and Pens would be considered assets of great value indeed. But now, if the market doesn't like a company, not only renowned trade names, but land, buildings, machinery, and what you will, can all count for nothing in its scales. Pascal said that the heart has its reasons that the reason doesn't understand. For heart read Wall Street, there is another contrast that comes to mind when the going is good and new issues are readily saleable, stock offerings of no qual. Idiot all make their appearance. They quickly find buyers. Their prices are often bid up enthusiastically right after issuance to levels in relation to assets and earnings that would put IBM, Xerox, and Polaroid to shame. Wall Street takes this madness in its stride with no overt efforts by anyone to call a halt before the inevitable collapse in prices. The SEC can't do much more than insist on disclosure of information about which the speculative public couldn't care less, or announce investigations and usually mild punitive actions of various sorts after the letter of the law has been clearly broken. When many of these minuscule but grossly inflated enterprises disappear from view, or nearly so, it is all taken philosophically enough as part of the game. Everybody swears off such inexcusable extravagances. Until next time. Thanks for the lecture, says the gentle reader. But what about your bargain issues? Can one really make money in them without taking a serious risk? Yes, indeed. If you can find enough of them to make a diversified group, and if you don't lose patience if they fail to advance soon after you buy them. Sometimes the patience profit needed may appear quite considerable. In our previous edition, we hazarded a single example, P188, which was current. As we wrote, it was Burton-Dixie Corp. With stock selling at 20% against net current asset value of 30 and book value of about 50. A on that purchase would not have been immediate, but in August 1967, all the shareholders were offered 53% for their shares, probably at just about book value. A patient holder who had bought the shares in March 1964 at 20 would have had a profit of 165% in 2 years, a non-compounded annual return of 47%. Most of the bargain issues in our experience have not taken that long to show good profits, nor have they shown so high a rate. For a somewhat similar situation, current as we write, see our discussion of National Presto Industries above, P168, special situations or workouts. Let us touch briefly on this area, since it is theoretically able in the program of operations of an enterprising investor. It was commented upon above. Here we shall supply some examples of the genre and some further remarks on what it appears to offer. An open-minded and alert investor. 3 such situations, among others, were current early in 1971, and they may be summarized as follows. Situation 1. Acquisition of Kaiser Roth by Borden's. In January 1971, Borden Inc. announced a plan to acquire control of Kaiser Roth Diversified Apparel by giving 1% shares of its own stock, in exchange for 1 share of Kaiser Roth. On the following day, in active trading, Borden closed at 26 and Kaiser Roth at 28. If an operator had bought 300 shares of Kaiser Roth and sold 400 Borden at these prices, and if the deal were later consummated on the announced terms, he would have had a profit of some 24% on the cost of his shares, less commissions and some other items. Assuming the deal had gone through in 6 months, his final profit might have been at about a 40% per annum rate. Situation 2. In November 1917, National Biscuit Company offered to buy control of Aurora Plastics Company at $11 in cash. The stock was selling at about 8%. It closed the month at 9 and continued to sell there at year-end. Here the gross profit indicated was originally about 25%, subject to the risks of non-consummation and to the time element. Situation 3. Universal Marrying Company, which had ceased its business operations, asked its shareholders to ratify dissolution of the concern. The treasurer indicated that the common stock had a book value of about 28% per share, a substantial part of which was in liquid form. The stock closed 1970 at 21%, indicating a possible gross profit here if book value was realized in liquidation of more than 30%. If operations of this kind, conducted on a diversified basis for spreading the risk, could be counted to yield annual profits of, say, 20% or better, they would undoubtedly be more than merely worthwhile. Since this is not a book on special situations, we are not going into the details of the business, for it really is a business. Let us point out 2 contradictory developments there in recent years. On the one hand, the number of deals to choose from has increased enormously as compared with, say, 10 years ago. This is a consequence of what might be called a mania of corporations to diversify their activities through various types of acquisitions, etc. In 1970, the number of merger announcements aggregated some 5,000, down from over 6,000 in 1969. The total money values involved in these deals amounted to many, many billions. Perhaps only a small fraction of the 5,000 announcements could have presented a clear-cut opportunity for purchase of shares by a special situations man, but this fraction was still large enough to keep him busy studying, picking, and choosing. The other side of the picture is that an increasing proportion of the mergers announced failed to be consummated. In such cases, of course, the aimed for profit is not realized and is likely to be replaced by a more or less serious loss. Reasons for non-success are numerous, including antitrust intervention, shareholder opposition, change in market conditions, unfavorable indications from further study, inability to agree on details, and others. The trick here, of course, is to have the judgment, buttressed by experience, to pick the deals most likely to succeed and also those which are likely to occasion the smallest loss if they fail. Further comment on the examples above. Kaiser Roth. The directors of this company had already rejected, in January 1971, the Borden proposal when this chapter was written. If the operation had been undone immediately, the overall loss, including commissions, would have been about 12%. All the cost of the Kaiser Roth shares. Aurora Plastics. Because of the bad showing of this company. In 1970, the takeover terms were renegotiated and the price reduced to 10%. The shares were paid for at the end of May. The annual rate of return realized here is about 25%. Universal Marion. This company promptly made an initial distribution in cash and stock worth about $7 per share, reducing the investment to say 14%. However, the market price fell as low as 13 subsequently, casting doubt on the ultimate outcome of the liquidation. Assuming that the 3 examples given are fairly representative of workout or arbitrage opportunities as a whole in 1971, it is clear that they are not attractive if entered into upon a random basis. This has become more than ever a field for professionals, with the requisite experience and judgment. There is an interesting sidelight on our Kaiser Roth example. Late in 1971, the price fell below 20% while Borden was selling at 25, equivalent to 33 for Kaiser Roth under the terms of the exchange offer. It would appear that either the directors had made a great mistake in turning down that opportunity, or the shares of Kaiser Roth were now badly undervalued in the market. Something for a security analyst to look into. Commentary on Chapter 15. It is easy in the world to live after the world's opinion. It is easy in solitude to live after our own. But the great man is he who in the midst of the crowd keeps with perfect sweetness the independence of solitude. Ralph Waldo Emerson. Practice Max Hein, founder of the Mutual Series funds, liked to say that there are many roads to Jerusalem. What this masterly stock picker meant was that his own value-centered method of selecting stocks was not the only way to be a successful investor. In this chapter, we'll look at several techniques that some of today's leading money managers use for picking stocks. First, though, it's worth repeating that for most investors, selecting individual stocks is unnecessary if not inadvisable. The fact that most professionals do a poor job of stock picking does not mean that most amateurs can do better. The vast majority of people who try to pick stocks learn that they are not as good at it as they thought. The luckiest ones discover this early on, while the less fortunate take years to learn it. A small percentage of investors can excel at picking their own stocks. Everyone else would be better off getting help, ideally through an index fund. Graham advised investors to practice first, just as even the greatest athletes and musicians practice and rehearse before every actual performance. He suggested starting off by spending a year tracking and picking stocks, but not with real money. In Graham's day, you would have practiced using a ledger of hypothetical buys and sells on a legal pad. Nowadays, you can use portfolio trackers at websites like www.morningstar.com, finance.yahoo.com, http money.cnn, com services portfolio, or www.marketocracy.com at the last site. Ignore the market-beating hype on its funds and other services. By test driving your techniques before trying them with real money. You can make mistakes without incurring any actual losses. Develop the discipline to avoid frequent trading. Compare your approach against those of leading money managers and learn what works for you. Best of all, tracking the outcome of all your stock picks will prevent you from forgetting that some of your hunches turn out to be stinkers. That will force you to learn from your winners and your losers. After a year, measure your results against how you would have done if you had put all your money in an S&P 500 index fund. If you didn't enjoy the experiment or your picks were poor, no harm done. Selecting individual stocks is not for you. Get yourself an index fund and stop wasting your time on stock picking. If you enjoyed the experiment and earned sufficiently good returns, gradually assemble a basket of stocks, but limit it to a maximum of 10% of your overall portfolio. Keep the rest in an index fund. And remember, you can always stop if it no longer interests you or your returns turn bad. Looking under the right rocks. Stock. You can, so how should you go about looking for a potentially rewarding? Use websites like finance.yahoo.com and www.morningstar.com to screen stocks with the statistical filter suggested in chapter . Or you can take a more patient, craftsman-like approach. Unlike most people, many of the best professional investors first get interested in a company when its share price goes down, not up. Christopher Brown of Tweedy Brown Global Value Fund, William Nygren of the Oakmark Fund, Robert Rodriguez of FPA Capi, Tal Fund, and Robert Torre of the Torre Fund all suggest looking at the daily list of new 52-week lows in the Wall Street Journal or the similar table in the Market Week section of Barron's. That will point you towards stocks and industries that are unfashionable or unloved and that thus offer the potential for high returns once. Change. Perceptions, Christopher Davis of the Davis Funds and William Miller of Legg. From EPs to RUC, net income or earnings per share, EP has been distorted in recent years by factors like stock option grants and accounting gains and charges. To see how much a company is truly earning on the capital it deploys in its businesses, look beyond EPs. 2. ROIC, or return on invested capital, Christopher Davis of the Davis Funds defines it with this formula: ROIC, owner earnings invested capital, where owner earnings is equal to operating profit plus depreciation plus amortization of goodwill minus federal income tax paid at the company's average rate minus cost of stock options minus maintenance or essential capital expenditures minus any income generated by unsustainable rates of return on pension funds as of 2003, anything greater than total assets, and where invested capital is equal to minus cash, as well as short-term investments and non-interest-bearing current liabilities, plus past accounting charges that reduced invested capital. ROIC has the virtue of showing, after all, legitimate expenses, what the company earns from its operating businesses and how efficiently it has used the shareholders' money to generate that return. And ROIC of at least 10% is attractive. Even 6% or 7% can be tempting if the company has good brand names, focused management, or is under a temporary cloud. Mason value. Trusts like to see rising returns on invested capital, or ROIC, a way of measuring how efficiently a company generates what Warren Buffett has called owner earnings. See the sidebar on P398 for more detail. By checking comparables, or the prices at which similar businesses have been acquired over the years. Managers like Oakmark's Nygren and Longleaf Partners O. Mason Hawkins get a better handle on what a company's parts are worth. For an individual investor, it's painstaking and difficult work. Start by looking at the business segment's footnote in the company's annual report, which typically lists the industrial sector revenues and earnings of each subsidiary. The management discussion and analysis may also be helpful. Then search a news database like Factiva, ProQuest, or LexisNexis for examples of other firms in the same industries that have recently been acquired, using the Edgar database at www.sec.gov to locate their past annual reports. You may be able to determine the ratio of purchase price to the earnings of those acquired companies. You can then apply that ratio to estimate how much a corporate acquirer might pay for a similar division of the company you are investigating. By separately analyzing each of the company's divisions this way, you may be able to see whether they are worth more than the current stock price. Longleaf Hawkins likes to find what he calls cent dollars, or companies whose stock is trading at or less of the value at which he appraises the businesses. That helps provide the margin of safety that Graham insists on. Who's the boss? Finally, most leading professional investors want to see that a company is run by people who, in the words of Oakmark's William Nygren, think like owners, not just managers. Two simple tests. Are the company's financial statements easily understandable, or are they full of obfuscation? Are non-recurring or extraordinary or unusual charges just that, or do they have a nasty habit of recurring? Longleaf Mason Hawkins looks for corporate managers who are good partners, meaning that they communicate candidly about problems, have clear plans for allocating current and future cash flow, and own sizable stakes in the company's stock, preferably through cash purchases rather than through grants of options. But if managements talk more about the stock price than about the business, Warren's Robert Torrey of the Torrey Fund were not interested. Christopher Davis of the Davis Funds favors firms that limit issuance of stock options to roughly 3% of shares outstanding. At Vanguard PrimeCap Fund, Howard Show tracks what the penny said one year and what happened the next. We want to see not only whether managements are honest with shareholders, but also whether they're honest with themselves. If a company boss insists that all is hunky-dory when business is sputtering, watch out nowadays. You can listen in on a company's regularly scheduled conference calls even if you own only a few shares to find out the schedule. Call the Investor Relations Department at corporate headquarters or visit the company's website. Robert Rodriguez of FPA Capital Fund turns to the back page of the company's annual report where the heads of its operating divisions are listed. If there's a lot of turnover in those names in the first 1 or 2 years of a new CEO's regime, that's probably a good sign. He's cleaning out the dead wood. But if high turnover continues, the turnaround has probably devolved into turmoil. Keeping your eyes on the road, there are even more roads to Jerusalem than these. Some leading portfolio managers like David Drummond of Drummond Value Management and Martin Whitman of the Third Avenue Funds focus on companies selling at very low multiples of assets, earnings, or cash flow. Others, like Charles Royce of the Royce Funds and Joel Tillinghast of Fidelity Low Price Stock Fund, hunt for undervalued small companies. And for an all-too-brief look at how today's most revered investor, Warren Buffett, selects companies, see the sidebar on P401. One technique that can be helpful: see which leading professional money managers own the same stocks you do, if 1 or 2 names. Keep turning up, go to the websites of those fund companies, and download their most recent reports. By seeing which other stocks these investors own, you can learn more about what qualities they. Warren's Way. Graham's greatest student, Warren Buffett, has become the world's most successful investor by putting new twists on Graham's ideas. Buffett and his partner Charles Munger have combined Graham's margin of safety and detachment from the market with their own innovative emphasis on future growth. Here is an all-too-brief summary of Buffett's approach. He looks for what he calls franchise companies with strong consumer brands, easily understandable businesses, robust financial health, and near monopolies in their markets. like H&R Block, Gillette, and the Washington Post Company. Buffett likes to snap up a stock when a scandal, big loss, or other bad news passes over it like a storm cloud, as when he bought Coca-Cola soon after its disastrous rollout of New Coke and the market crash of 1987. He also wants to see managers who set and meet realistic goals, build their businesses from within rather than through acquisition, allocate capital wisely, and do not pay themselves $100 million jackpots. Of stock options. Buffett insists on steady and sustainable growth in earnings, so the company will be worth more in the future than it is today. In his annual reports archived at www.berkshirehathaway.com, Buffett has set out his thinking like an open book. Probably no other investor, Graham included, has publicly revealed more about his approach or written such compellingly readable essays. One classic Buffett proverb: when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. Every intelligent investor can and should learn by reading this master's own words. Have in common, by reading the manager's commentary, you may get ideas on how to improve your own approach. 3. No matter which techniques they use in picking stocks, successful investing professionals have two things in common. First, they are disciplined and consistent, refusing to change their approach even when it is unfashionable. Second, they think a great deal about what they do and how to do it, but they pay very little attention to what the market is doing. Chapter 16. Convertible issues and warrants. Convertible bonds and preferred stocks have been taking on a predominant importance in recent years in the field of senior financing. As a parallel development, stock option warrants, which are long-term rights to buy common shares at stipulated prices, have become more and more numerous. More than half the preferred issues now quoted in the Standard Poor Stock Guide have conversion privileges. And this has been true also of a major part of the corporate bond financing in 1968 to 1970. There are at least 60 different series of stock option warrants dealt in on the American Stock Exchange. In 1970, for the first time in its history, the New York Stock Exchange listed an issue of long-term warrants, giving rights to buy 31,400,000 American Intel shares at $52 each. With Mother Bell now leading that procession, it is bound to be augmented by many new fabricators of warrants. As we shall point out later, they are fabrication in more than one sense. In the overall picture, the convertible issues rank as much more important than the warrants, and we shall discuss them first. There are two main aspects to be considered from the standpoint of the investor. First, how do they rank as investment opportunities and risks? Second, how does their existence affect the value of the related common stock issues? Convertible issues are claimed to be especially advantageous to both the investor and the issuing corporation. The investor receives the superior protection of a bond or preferred stock, plus the opportunity to participate in any substantial rise in the value of common stock. The issuer is able to raise capital at a moderate interest or preferred dividend cost. And if the expected prosperity materializes, the issuer will get rid of the senior obligation by having it exchanged into common stock. Thus, both sides of the bargain will fare unusually well. Obviously, the foregoing paragraph must overstate the case somewhere, for you cannot by a mere ingenious device make a bar game much better for both sides. In exchange for the conversion privilege, the investor usually gives up something important in quality or yield, or both. Conversely, if the company gets its money at lower cost because of the conversion feature, it is surrendering in return part of the common shareholders' claim to future enhancement. On this subject, there are a number of tricky arguments to be advanced, both pro and con. The safest conclusion that can be reached is that convertible issues are like any other form of security, in that their form itself guarantees neither attractiveness nor unattractiveness. That question will depend on all the facts surrounding the individual issue. We do know, however, that the group of convertible issues floated during the latter part of a bull market are bound to yield unsatisfactory results as a whole. It is at such optimistic periods, unfortunately, that most of the convertible financing has been done in the past. The poor consequences must be inevitable from the timing itself, since a wide decline in the stock market must invariably make the conversion privilege much less attractive and often also call into question the underlying safety of the issue itself. As a group illustration, we shall retain the example used in Price BLC. Table, Cumberland. Council 668,198 6. 6997. H. Our first edition of the relative price behavior of convertible and straight, non-convertible preferreds offered in 1946. the closing year of the bull market preceding the extraordinary one that began in 1949. A comparable presentation is difficult to make for the years 1967 to 1970 because there were virtually no new offerings of non-convertibles in those years. But it is easy to demonstrate that the average price decline of convertible preferred stocks from December 1967 to December 1970 was greater than that for common stocks as a whole, which lost only 5%. Also, the convertibles seem to have done quite a bit worse than the older straight preferred shares during the period December 1968 to December 1970, as is shown by the sample of 20 issues of each kind in Table 16-2. These, 469, Benjamin, 1894, says, comparisons would demonstrate that convertible securities as a whole have relatively poor quality as senior issues and also are tied to common stocks that do worse than the general market except during a speculative upsurge. These observations do not apply to all convertible issues, of course. In the 1968 and 1969 particularly, a fair number of strong companies used convertible issues to combat the inordinately high interest rates for even first-quality bonds. But it is noteworthy that in our 20 stock sample of convertible preferreds, only 1 showed an advance and 14 suffered bad declines. The conclusion to be drawn from these figures is not that convertible issues are in themselves less desirable than non-convertible or straight securities. Other things being equal, the opposite is true, but we clearly see that other things are not equal in practice, and that the addition of the conversion privilege often, perhaps generally, betrays an absence of genuine investment quality for the issue. It is true, of course, that a convertible preferred is safer than the common stock of the same company. That is to say, it carries smaller risk of eventual loss of principal. Consequently, those who buy new convertibles instead of the corresponding common stock are logical to that extent. But in most cases, the common would not have been an intelligent purchase to begin with at the ruling price, and the substitution of the convertible preferred did not improve the picture sufficiently. Furthermore, a good deal of the buying of convertibles was done by investors who had no special interest or confidence in the common stock, that is. They would never have thought of buying the common at the time, but who were tempted by what seemed an ideal combination of a prior claim plus a conversion privilege close to the current market. In a number of instances, this combination has worked out well, but the statistics seem to show that it is more likely to prove a pitfall. In connection with the ownership of convertibles, there is a SPE CL problem which most investors fail to realize. Even when a profit appears, it brings a dilemma with it. Should the holder sell on a small rise? Should he hold for a much bigger advance if the issue is called, as often happens when the common has gone up considerably? Should he sell out then or convert into and retain the common stock? Let us talk in concrete terms. You buy a 6% bond at 100%, convertible into stock at 25%, that is, at the rate of 40 shares for each 1,000 bond. The stock goes to 30, which makes the bond worth at least 120, and so it sells at 125. You either sell or hold. If you hold, ing for a higher price, you are pretty much in the position of a shareholder, since if the stock goes down, your bond will go down too. A conservative person is likely to say that beyond 125, misposition has become too speculative, and therefore he sells and makes a gratifying 25% profit. So far, so good. But pursue the matter a bit. In many cases where the holder sells at 125, the common stock continues to advance, carrying the convertible with it. And the investor experiences that peculiar pain that comes to the man who has sold out much too soon. The next time he decides to hold for 150 or 200, the issue goes up to 140 and he does not sell. Then the market breaks and his bond slides down to 80. Again, he has done the wrong thing. Aside from the mental anguish involved in making these bad guesses, and they seem to be almost inevitable there, is a real arithmetical drawback to operations in convertible issues. It may be assumed that the stern and uniform policy of selling at 25% or 30% profit will work out best as applied to many holdings. This would then mark the upper limit of profit and would be realized only on the issues that worked out well. But if, as appears to be true, these issues often lack adequate underlying security and tend to be floated and purchased in the latter stages of a bull market, then a goodly proportion of them will fail to rise to 125, but will not fail to collapse when the market turns downward. Thus, the spectacular opportunities in convertibles prove to be illusory in practice. And the overall experience is marked by fully as many substantial losses, at least of a temporary kind, as there are gains of similar magnitude. Because of the extraordinary length of the 1,951,968 bull market, convertible issues as a whole gave a good account of themselves for some 18 years. But this meant only that the great majority of common stocks enjoyed large advances in which most convertible issues were able to share. The soundness of investment in convertible issues can only be tested by their performance in a declining stock market, and this has always proved disappointing as a whole. In our first edition, 1949, we gave an illustration of the special PRB is PPE1 problem of what to do with a convertible when it goes up. We believe it still merits inclusion here. Like several of our references, it is based on our own investment operations. We were members of a select group, mainly of investment funds, who participated in a private offering of convertible 41.2% debentures of Eversharp Company at par, convertible into common stock at $40 per share. The stock advanced rapidly to 65%, and then, after a 3-for-2 split, to the equivalent of 88. The latter price made the convertible debentures worth no less than $220. During this period, the two issues were called at a small premium. Hence, they were practically all converted into common stock, which was retained by a number of the original investment fund buyers of the debentures. The price promptly began a severe decline, and in March 1948, the stock sold as low as 7%. This represented a value of only 27 for the debenture issues, or a loss of 75% of the original price, instead of a profit of over 100%. The real point of this story is that some of the original purchasers converted their bonds into the stock and held the stock through its great decline. In so doing, they ran counter to an old maxim of Wall Street, which runs, "Never convert a convertible bond." Why this advice? Because once you convert, you have lost your strategic combination of prior claimant to interest, plus a chance for an attractive profit. You have probably turned from investor into speculator, and quite often at an unpropitious time, because the stock has already had a large advance. If never convert a convertible is a good rule, how came it that these experienced fund managers exchanged their Eversharp bonds for stock to their subsequent embarrassing loss? The answer, no doubt, is that they let themselves be carried away by enthusiasm for the company's prospects, as well as by the favorable market action of the shares. Wall Street has a few prudent principles. The trouble is that they are always forgotten when they are most needed. Hence that other famous dictum of the old-timers, "Do as I say, not as I do." Our general attitude toward new convertible issues is thus a mistrustful one. We mean here, as in other similar observations, that the investor should look more than twice before he buys them. After such hostile scrutiny, he may find some exceptional offerings that are too good to refuse. The ideal combination, of course, is A, strongly secured convertible, exchangeable for a common stock, which itself is attractive, and at a price only slightly higher than the current market. Every now and then a new offering appears that meets these requirements. By the nature of the securities markets, however, you are more likely to find such an opportunity in some older issue which has developed into a favorable position rather than in a new flotation. If a new issue is a really strong one, it is not likely to have a good conversion privilege. The fine balance between what is given and what is withheld in a standard type convertible issue is well illustrated by the extensive use of this type of security in the financing of American Telephone and Telegraph Company. Between 1913 and 1957, the company sold at least 9 separate issues of convertible bonds, most of them through subscription rights to shareholders. The convertible bonds had the important advantage to the company of bringing in a much wider class of buyers than would have been available for a stock offering, since the bonds were popular with many financial institutions which possess huge resources, but some of which were not permitted to buy stocks. The interest return on the bonds has generally been less than half the corresponding dividend yield on the stock, a factor that was calculated to offset the prior claim of the bondholders. Since the company maintained its $9 dividend rate for 40 years, from 1919 to the stock split in 1959, the result was the eventual conversion of virtually all the convertible issues into common stock. Thus, the buyers of these convertibles have fared well through the years, but not quite so well as if they had bought the capital stock in the first place. This example establishes the soundness of American Telephone and Telegraph, but not the intrinsic attractiveness of convertible bonds. To prove them sound and the convertible worked out well, even though the common stock practice, we should need to have a number of instances in which proved disappointing. Such instances are not easy to find. Effect of convertible issues on the status of the common stock. In a large number of cases, convertibles have been issued in connection with mergers or new acquisitions. Perhaps the most striking example of this financial operation was the issuance by the NVF Corp. Of nearly $100,000, 0.0000 of its 5% convertible bonds, plus warrants, in exchange for most of the common stock of Sharon Steel Company. This extraordinary deal is discussed below PP, 429 minus 433. Typically, the transaction results in a pro forma increase in the reported earnings per share of common stock. The shares advance in response to their larger earnings, so-called, but also because the management has given evidence of its energy, enterprise, and ability to make more money for the shareholders. But there are two offsetting factors, one of which is practically ignored and the other entirely so in optimistic markets. The first is the actual dilution of the current and future earnings on the common stock that flows arithmetically from the new conversion rights. This dilution can be quantified by taking the recent earnings or assuming some other figures and calculating the adjusted earnings per share if all the convertible shares or bonds were actually converted. In the majority of companies, the resulting reduction in per share figures is not significant. But there are numerous exceptions to this statement, and there is danger that they will grow at an uncomfortable rate. The fast expanding conglomerates have been the chief practitioners of convertible legerdemain. In Table 16-3, we list 7 companies with large amounts of stock issuable on conversions, or against warrants.t, indicated switches from common into preferred stocks for decades before, say, 1956, common stocks yielded more than the preferred stocks of the same companies. This was particularly true if the preferred stock had a conversion privilege close to the market. The reverse is generally true at present. As a result, there are a considerable number of convertible preferred stocks, which are clearly more attractive than the related common shares. Owners of the common have nothing to lose in important advantages to gain by switching from their junior shares into the senior issue. Example. A typical example was presented by Studebaker, Worthington Corp. At the close of 1970. The common sold at 57, while the 5 convertible preferred finished at 87%. Each preferred share is exchangeable for 11 shares of common, then worth 85%. This would indicate a small money difference against the buyer of the preferred. But dividends are being paid on the common at the annual rate of $1.20 or $1.80 for the 11 shares against the $5 obtainable on 1 share of preferred. Thus, the original adverse difference in price would probably be made up in less than a year, after which the preferred would probably return an appreciably higher dividend yield than the common for some time to come. But most important, of course, would be the senior position that the common shareholder would gain from the switch. At the low prices of 1968 and again in 1970, the preferred sold 15 points higher than 11 shares of common. Its conversion privilege guarantees that it could never sell lower than the common package. 2. Stock option warrants. Let us mince no words at the outset. We consider the recent development of stock option warrants as a near fraud and existing menace and a potential disaster. They have created huge aggregate dollar values out of thin air. They have no excuse for existence, except to the extent that they mislead speculators and investors. They should be prohibited by law, or at least strictly limited to a minor part of the total capitalization of a company. For an analogy in general history and in literature, we refer the reader to the section of Faust, Part 2, in which Goethe describes the invention of paper money. As an ominous precedent on Wall Street history, we may mention the warrants of American and Foreign Power Company, which in 1929 had a quoted market value of over $1 billion, although they appeared only in a footnote to the company's balance sheet. By 1932, this $1 billion had shrunk to $8 million, and in 1952, the warrants were wiped out in the company's recapitalization, even though it had remained solvent. Originally, stock option warrants were attached now and then to bond issues and were usually equivalent to a partial conversion privilege. They were unimportant in amount and hence did no harm. Their use expanded in the late 1920s, along with many other financial abuses, but they dropped from sight for long years thereafter. They were bound to turn up again, like the bad pennies they are, and since 1967, they have become familiar instruments of finance. In fact, a standard procedure has developed for raising the capital for new real estate ventures, affiliates of large banks, by selling units of an equal number of common shares and warrants to buy additional common shares at the same price. Example, in 1971, Cleft Trust Realty investors sold 500,000 of these combined shares of common stock or shares of beneficial interest. And war unit rants for $20 per. Let us consider for a moment what is really involved in this financial setup. Ordinarily, a common stock issue has the first right to buy additional common shares when the company's directors find it desirable to raise capital in this manner. This so-called preemptive right is one of the elements of value entering into the ownership of common stock, along with the right to receive dividends, to participate in the company's growth, and to vote for directors. When separate warrants are issued for the right to subscribe additional capital, that action takes away part of the value inherent in an ordinary common share and transfers it to a separate certificate. An analogous thing could be done by issuing separate certificates for the right to receive dividends for a limited or unlimited period, or the right to share in the proceeds of sale or liquidation of the enterprise, or the right to vote the shares. Why then are these subscription warrants created as part of the original capital structure? Simply because people are inexpert in financial matters. They don't realize that the common stock is worth less with warrants outstanding than otherwise. Hence, the package of stock and warrants usually commands a better price in the market than with the stock alone. Note that in the usual company reports, the per-share earnings are or have been computed without proper allowance for the effect of outstanding warrants. Their salt is, of course, to overstate the true relationship between the earnings and the market value of the company's capitalization. The simplest and probably the best method of allowing for the existence of warrants is to add the equivalent of their market value to the common share capitalization, thus increasing the true market price per share. Where large amounts of warrants have been issued in connection with the sale of senior securities, it is customary to make the adjustment by assuming that the proceeds of the stock payment are used to retire the related bonds or preferred shares. This method does not allow adequately for the usual premium value of a warrant above exercisable value. In Table 16-4, we compare the effect of the two methods of calculation in the case of National General Corp. For the year 1970. Does the company itself derive an advantage from the creation of these warrants in the sense that they assure it in some way of receiving additional capital when it needs some? Not at all. Ordinarily, there is no way in which the company can require the warrant holders to exercise their rights and thus provide new capital to the company prior to the expiration date of the warrants. In the meantime, if the company wants to raise additional common stock, funds it must offer the shares to its shareholders in the usual way, which means somewhat under the ruling market price. The warrants are no help in such an operation. They merely complicate the situation by frequently requiring a downward revision in their own subscription price. Once more, we assert that large issues of stock option warrants serve no purpose except to fabricate imaginary market values. The paper money that Goethe was familiar with when he wrote his Faust were the notorious French assignats that had been greeted as a marvelous invention, and were destined ultimately to lose all of their value, as did the $1 billion worth of American tea foreign power warrants. Some of the poet's remarks apply. Practical postscript. The crime of the warrants is in having been born. Once born, they function as other security forms and offer chances of profit as well as of loss. Nearly all the newer warrants run for a limited time, generally between 5 and 10 years. The older warrants were often perpetual, and they were likely to have fascinating price. Histories over the years. Example, the record books will show that Tri-Continental Corp. Warrants, which date from 1929, sold at a negligible 1/32 of a dollar each in the depth of the Depression. From that lowly estate, their price rose to a magnificent 75% in 1969, an astronomical advance of some 242,000%. The warrants then sold considerably higher then. The shares themselves. This is the kind of thing that occurs on Wall Street through technical developments, such as stock splits. A recent example is supplied by Ling Temco Vought warrants, which in the first half of 1971 advanced from 2% to 12% and then fell. Back to 4. No doubt shrewd operations can be carried on in warrants from time to time, but this is too technical a matter for discussion here. We might say that warrants tend to sell relatively higher than the corresponding market components related to the conversion privilege of bonds or preferred stocks. To that extent, there is a valid argument for selling bonds with warrants attached rather than creating an equivalent dilution factor by a convertible issue. If the warrant total is relatively small, there is no point in taking its theoretical aspect too seriously. If the warrant issue is large relative to the outstanding stock, that would probably indicate that the company has a top-heavy senior capitalization. It should be selling additional common stock instead. Thus, the main objective of our attack on warrants as a financial mechanism is not to condemn their use in connection with moderate-sized bond issues, but to argue against the wanton creation of huge paper money monstrosities of this genre. Commentary on Chapter 16. That which thou sowest is not quickened, except it die. I Corinthians XV. The zeal of the convert. Although convertible bonds are called bonds, they behave like stocks, work like options, and are cloaked in obscurity. If you own a convertible, you also hold an option. You can either keep the bond and continue to earn interest on it, or you can exchange it for common stock of the issuing company at a predetermined ratio. An option gives its owner the right to buy or sell another security at a given price within a specific period of time. Because they are exchangeable into stock, convertibles pay lower rates of interest than most comparable bonds. On the other hand, if a company's stock price soars, a convertible bond exchangeable into that stock will perform much better than a conventional bond. Conversely, the typical convertible with its lower interest rate will fare worse in a falling bond market. From 1957 through 2002, according to Ibbotson Associates, convertible bonds earned an annual average return of 8.3%, only 2 percentage points below the total return on stocks, but with steadier prices and shallower losses. Bought to more income, less risk than stocks. No wonder Wall Street salespeople often describe convertibles as a best of both worlds investment. But the intelligent investor will quickly realize that convertibles offer less income and more risk than most other bonds. So they could, by the same logic and with equal justice, be called a worst of both worlds investment. Which side you come down on depends on how you use them. In truth, convertibles act more like stocks than bonds. The return on convertibles is about 83% correlated to the Standard & Poor's 500 stock index, but only about 30% correlated to the performance of Treasury bonds. Thus, converts zig when most bonds zag. For conservative investors with most or all of their assets in bonds, adding a diversified bundle of converts is a sensible way to seek stock-like returns without having to take the scary step of investing in stocks directly. You could call convertible bond stocks for chickens. As convertibles expert F.F. Barry Nelson of Advent Capital Management points out, this roughly $200 billion market has blossomed since Graham's day. Most converts are now medium-term, in the 7 to 8 year range, roughly half are investment grade, and many issues now carry some call protection and assurance against early redemption. All these factors make them less risky than they used to be. 3. It's expensive to trade small lots of convertible bonds, and diversification is impractical unless you have well over $100. 0,000 to invest in this sector alone. Fortunately, today's intelligent investor has the convenient recourse of buying a low-cost convertible bond fund. Fidelity and Vanguard offer mutual funds with annual expenses comfortably under 1%, while several closed-end funds are also available at a reasonable cost, and, occasionally, at discounts to net asset value. On Wall Street, cuteness and complexity go hand in hand, and convertibles are no exception. Among the newer varieties are a jumble of securities with acronymic nicknames like Lions, Elks, Eyes, Perks, MIPS, Chips, and Yields. These intricate securities put a floor under your potential losses, but also cap your potential profits and often compel you to convert into common stock on a fixed date. Like most investments that purport to insure against loss, see sidebar on P421, these things are generally more trouble than they are worth. You can best shield yourself against loss not by buying one of these quirky contraptions, but by intelligently diversifying your entire portfolio across cash, bonds, and U.S. and foreign stocks. Uncovering covered calls. As the bear market clawed its way through 2003, it dug up an old fad, writing covered call options, a recent Google search. Uncovered call writing turned up more than 2,600 hits. What are covered calls and how do they work? Imagine that you buy 100 shares of Ixnay Corp at $95 a piece. You then sell, or write, a call option on your shares. In exchange, you get a cash payment known as a call premium. Let's say it's $10 per share. The buyer of the option, meanwhile, has the contractual right to buy your Ixnay shares at a mutually agreed upon price. Say $100, you get to keep the stock so long as it stays below $100 and you earn a fat $1,000 in premium income, which will cushion the fall if Ixnay stock crashes. Less risk, more income. What's not to like? Well, now imagine that Ixnay stock price jumps overnight to $110. Then your option buyer will exercise his rights, yanking $1,000 your shares away for $100 a piece. You've still got your income, but he's got your Ixnay, and the more it goes up, the harder you will kick yourself. Since the potential gain on a stock is unlimited, while no loss can exceed 100%, the only person you will enrich with this strategy is your broker. You've put a floor under your losses, but you've also slapped a ceiling over your gains. For individual investors, covering your downside is never worth surrendering most of your upside. Chapter 17 Rands. 4 extremely instructive case histories. The word extremely in the title is a kind of pun, because the histories represent extremes of various sorts that were manifest on Wall Street in recent years. They hold instruction and grave warnings for everyone who has a serious connection with the world of stocks and bonds, not only for ordinary investors and speculators, but for professionals, security analysts, fund managers, trust account administrators, and even for bankers who lend money to corporations. The 4 companies to be reviewed and the different extremes that they illustrate are Penn Central Railroad Company, an extreme example of the neglect of the most elementary warning signals of financial weakness by all those who had bonds or shares of this system under their supervision. A crazily high market price for the stock of a tottering giant. Ling Temco Vought Inc., an extreme example of quick and unsound empire building with ultimate collapse practically guaranteed, but helped by indiscriminate bank lending. NVF Corp., an extreme example of one corporate acquisition in which a small company absorbed another 7 times its size, incurring a huge debt and employing some startling accounting devices. AAA Enterprises, an extreme example of public stock financing of a small company, its value based on the magic word franchising and little else, sponsored by important stock exchange houses. Bankruptcy followed within 2 years of the stock sale and the doubling of the initial inflated price in the heedless stock market, the Penn Central case. This is the country's largest railroad in assets and gross revenues. Its bankruptcy in 1970 shocked the financial world. It has defaulted on most of its bond issues and has been in danger of abandoning its operations entirely. Its security issues fell drastically. Callion price, the common stock, collapsing from a high level of 86 as recently as 1968 to a low of 5% in 1970. There seems little doubt that these shares will be wiped out in reorganization. Our basic point is that the application of the simplest rules of security analysis and the simplest standards of sound investment would have revealed the fundamental weakness of the Penn Central system long before its bankruptcy, certainly in 1968, when the shares were selling at their post 1,929 record, and when most of its bond issues could have been exchanged at even prices for well-secured public utility obligations with the same coupon rates. The following comments are in order. 1. In the S&P bond guide, the interest charges of the system are shown to have been earned 1.91 times in 1967 and 1.98 times in 1968. The minimum coverage prescribed for railroad bonds in our textbook security analysis is 5 times before income taxes and 2.9 times after income taxes at regular rates. As far as we know, the validity of these standards has never been questioned by any investment authority. On the basis of our requirements for earnings after taxes, the Penn Central fell short of the requirements for safety. But our after-tax requirement is based on a before-tax ratio of 5 times, with regular income tax deducted after the bond interest. In the case of Penn Central, it had been paying no income taxes to speak of for the past 11 years. Hence, the coverage of its interest charges before taxes was less than 2 times, a totally inadequate figure against our conservative requirement of 5 times. 2. The fact that the company paid no income taxes over so long a period should have raised serious questions about the validity of its reported earnings. 3. The bonds of the Penn Central system could have been exchanged in 1968 and 1969 at no sacrifice of price or income for far better secured issues. For example, in 1969, Pennsylvania R41 ran 2 seconds. Due 1994, part of Penn Central had a range of 61 to 74. While Pennsylvania Electric Company 4's due 1994 had a range of 64% to 72%. The public utility had earned its interest 4.20 times before. Taxes in 1968 against only 1.98 times for the Penn Central system. During 1969, the latter's comparative showing grew steadily worse. An exchange of this sort was clearly called for, and it would have been a lifesaver for a Penn Central bondholder. At the end of 1970, the railroad 4 seconds were in default and selling at only 18%, while the utilities 4% closed at 4. Penn Central reported earnings of $3.80 per share in 1968. Its high price of 86% that year was 24 times such earnings. But any analyst worth his salt would have wondered how real were earnings of this sort reported without the necessity of paying any income taxes thereon. 5. For 1966, the new emerged company had reported earnings of $6.80 a share, in reflection of which the common stock later rose to its peak of 86%. This was a valuation of over $2 billion for the equity. How many of these buyers knew at the time that the so lovely earnings were before a special charge of $275 million of $12 per share to be taken in 1971 for costs and losses incurred on the merger? Oh, wondrous fairyland of Wall Street, where a company can announce profits of $6.80 per share in one place and special costs and losses off $12 in another. And shareholders and speculators rub their hands with glee. 6. A railroad analyst would have long since known that the operating picture of the Penn Central was very bad in comparison with the more profitable roads. For example, its transportation ratio was 47.5% in 1968 against 35.2% for its neighbor, Norfolk Amp. Western. 7. Along the way, there were some strange transactions with peculiar accounting results. Details are too complicated to go into here. Conclusion. Whether better management could have saved the Penn Central bankruptcy may be arguable. But there is no doubt whatever that no bonds and no shares of the Penn Central system should have remained after 1968 at the latest in any securities account watched over by competent security analysts, fund managers, trust officers, or investment counsel. Moral: security analysts should do their elementary jobs before they study stock market movements, gaze into crystal balls, make elaborate mathematical calculations, or go on all-expense-paid field trips. Ling-Temco-Vought Inc. This is a story of head-over-heels expansion and head-over-heels debt ending up in terrific losses and a host of financial problems. As usually happens in such cases, a fair-haired boy or young genius was chiefly responsible for both the creation of the great empire and its ignominious downfall. But there is plenty of blame to be accorded. Others as well. The rise and fall of Ling-Temco-Vought can be summarized by setting forth condensed income accounts and balance sheet items for 5 years between 1958 and 1970. This is done in Table 17-1. The first column shows the company's modest beginnings in 1958 when its sales were only $7 million. The next gives figures for 1960. The enterprise had grown 20-fold in only 2 years, but it was still comparatively small. Then came the heyday years to 1967 and 1968, in which sales again grew 20-fold to $2.8 billion, with the debt figure expanding from $44 million to an awesome $1,653 million. In 1969 came new acquisitions, a further huge increase in debt to a total of $1,865 million, and the beginning of serious trouble. A large loss after extraordinary items was reported for the year. The stock price declined from its 1967 high of 169% to a low of 24. The young genius was superseded as the head of the company. The 1970 results were even more dreadful. The enterprise reported a final net loss of close to $70 million. The stock fell away to a low price of 7%, and its largest bond issue was quoted at one time at a pitiable 15 cents on the dollar. The company's expansion policy was sharply reversed, various of its important interests were placed on the market, and some headway was made in reducing its mountainous obligations. The figures in our table speak so eloquently that few comments are called for. But here are some. 1. The company's expansion period was not without an interruption. In 1961, it showed a small operating deficit, but adopting a practice that was to be seen later in so many reports for 1970, evidently decided to throw all possible charges and reserves into the one bad year. These amounted to around $13 million, which was more than the combined net profits of the preceding 3 years. It was now ready to show record earnings in 1962, etc. 2. At the end of 1966, the net tangible assets are given as $7.66 per share of common, adjusted for a 3-for-2 split. Thus, the market price in 1967 reached 22 times its reported asset value at the time. At the end of 1968, the balance sheet showed $286 million available for 3,800,000 shares of common and Class AA stock, or about $77 per share. But if we deduct the preferred stock at full value and exclude the goodwill items and the huge bond discount asset, there would remain $13 million for the common, a mere $3 per share. This tangible equity was wiped out by the losses of the following years. 3. Toward the end of 1967, 2 of our best-regarded banking firms offered 600,000 shares of Ling Temco Vought stock at $111 per share. It had been as high as 169%. In less than 3, price fell to years the Ambibenimo oft figure the TB B it THF4. At the end of 1967, the bank loans had reached $161 million, and a year later they stood at $414 million, which should have been a frightening figure. In addition, the long-term debt amounted to $1,237 million. By 1969 combined, debt reached a total of $1,869 million. This may have been the largest combined debt industrial figure of company anywhere and at any time, with the single exception of the impregnable Standard Oil of NJ/NE5. The losses in 1969 and 1970 far exceeded the total profits since the formation of the company. Moral: the primary question raised in our mind by the Ling Temco Vought story is how the commercial bankers could have been persuaded to lend the company such huge amounts of money during its expansion period. In 1966 and earlier, the company's coverage of interest charges did not meet conservative standards. And the same was true of the ratio of current assets to current liabilities and of stock equity to total debt. But in the next 2 years, the banks advanced the enterprise nearly $400 million additional for further diversification. This was not good business for them, and it was worse in its implications for the company's shareholders. If the Ling Temco Vought case will serve to keep commercial banks from aiding and abetting unsound expansions of this type, and the good may come of it at last. Future sum. The NVF takeover of Sharon Steel, a collector's item. At the end of 1968, NVF Company was a company with $4.6 million. Line of long-term debt, $17.4 million of stock capital, $31 million of sales, and $502,000 of net income before a special credit of $374,000. Its business was described as vulcanized fiber and plastics. 1915. 53. Jamin. 1894, which had $43 million of long-term debt, $101 million of stock capital, $219 million of sales, and $929,000 of net earnings. The company it wished to acquire was thus 7 times the size of NVF. In early 1969, it made an offer for all the shares of Sharon. The terms per share were $70 face amount of NVF Junior 5 bonds due 1994, plus warrants to buy 11 shares of NVF stock at $22 per share of NVF. The management of Sharon strenuously resisted this takeover attempt, but in vain. NVF acquired 88% of the Sharon stock under the offer, issuing therefore $102 million of its 5 bonds and warrants for 2,197,000 of its shares. Had the offer been 100%, operative the consolidated enterprise would, for the year 1968, have had $163 million in debt, only $2.2 million in tangible stock capital, $250 million of sales. The net earnings question would have been a bit complicated, but the company subsequently stated them as a net loss of 50 cents per share of NVF stocks before an extraordinary credit, and net earnings of 3 cents per share after such credit. First comment. Among all the takeovers effected in the year 1969, this was no doubt the most extreme in its financial disproportions. The acquiring company had assumed responsibility for a new and top-heavy debt obligation, and it had changed its calculated 1968 earnings from a profit to a loss into the bargain. EMEA, buy this, for LA. Step is found in the fact that the new 5 bonds did not sell higher than 42 cents on the dollar during the year of issuance. This would have indicated grave doubt of the safety of the bonds and of the company's future. However, the management actually exploited the bond price in a way to save the company annual income taxes of about $1 million, as will be shown. The 1968 report, published after the Sharon takeover, contained a condensed picture of its results carried back to the year-end. This contained 2 most unusual items. 1. There is listed as an asset $58,600,000 of deferred debt expense. This sum is greater than the entire stockholders' equity placed at $40,200,000. 2. However, not included in the shareholders' equity is an item of $20,700,000 designated as excess of equity over cost of investment in Sharon. Second comment, if we eliminate the debt expense as an asset, which it hardly seems to be, and include the other item in the shareholders' equity where it would normally belong, then we have a more realistic statement of tangible equity for NVF stock, vias $2,200,000. Thus, the first effect of the deal was to reduce NVF's real equity from $17,400,000 to $2,200. 0.0000, or from $23.71 per share to about $3 per share on 731,000 shares. In addition, the NVF shareholders had given to others the right to buy 31.2 times as many additional shares at 6 points below the market price at the close of 1968. The initial market value of the warrants was then about $12 each, or a total of some $30 million for those involved in the purchase offer. Actually, the market value of the warrants well exceeded the total market value of the outstanding NVF stock, and other evidence of the tail-wagging dog nature of the transaction. The accounting gimmicks: when we pass from this pro forma balance sheet to the next year's report, we find several strange appearing entries. In addition to a basic interest expense, a hefty $7,500,000, there is deducted $2,795, 0.000 for amortization of deferred debt expense. But this last is nearly offset on the next line by a very unusual income item. Indeed, amortization of equity over cost of investment in subsidiary, CR, $1,650,000. In one of the footnotes, we find an entry, not appearing in any other report that we know of, part A, the stock. Capital is there designated as fair market value of warrants issued in connection with acquisition, etc., $22,129,000. What on earth do all these entries mean? None of them is even referred to in the descriptive text of the 1969 report. The trained security analyst has to figure out these mysteries by himself, almost in detective fashion. He finds that the underlying idea is to derive a tax advantage from the low initial price of the 5% debentures. For readers who may be interested in this ingenious arrangement, we set forth our solution in Appendix 6. Other unusual items. 1. Right after the close of 1969, the company bought in no less than 650,000 warrants at a price of $9.38 each. This was extraordinary when we consider that NVF itself had only $700,000 in cash at the year end and had $4,400. 0.000 of debt due in 1970. Evidently, the $6 million paid for the warrants had to be borrowed. B. It was buying in this warrant paper money at a time when its 5% bonds were selling at less than 40 cents on the dollar, ordinarily a warning that financial difficulties lay ahead, too. As a partial offset to this, the company had retired $5,100,000 of its bonds along with 253,000 warrants in exchange for a like amount of common stock. This was possible because, by the vagaries of the securities markets, people were selling the 5% bonds at less than 40%, while the commons sold at an average price of 13%, paying no dividend. 3. The company had plans in operation not only for selling stock to its employees, but also for selling them a larger number of warrants to buy the stock. Like the stock purchases, the warrants were to be paid for 5% down and the rest over many years in the future. This is the only such employee purchase plan for warrants we know of. Will someone soon invent and sell on installments a right to buy a share, and so on? 4. In the year 1969, the newly controlled Sharon Steel Company changed its method at arriving at its pension costs, and also www.lo.org. Adopted lower depreciation rates. These accounting changes added about $1 per share to the reported earnings of NVF before dilution. 5. At the end of 1970, Standard & Poor's Stock Guide reported that NVF shares were selling at a price, earning ratio of only 2%, the lowest figure for all the 500-odd issues in the booklet. As the old Wall Street saying went, this was important if true. The ratio was based on the year's closing price of 8% and the computed earnings of $5.38 per share for the 12 months ended September 1970. Using these figures, the shares were selling at only 1.6 times earnings. But this ratio did not allow for the large dilution factor, nor for the adverse results actually realized in the last quarter of 1970. When the full year's figures finally appeared, they showed only $2.03 per share earned for the stock before allowing for dilution and $1.80 per share on a diluted basis. Note also that the aggregate market price of the stock and warrants on that date was about $14 million against a bonded debt of $135 million, a skimpy equity position indeed. AAA Enterprises. History. About 15 years ago, a college student named Williams began selling mobile homes, then called trailers. In 1965, he and Corpo Company rated his business. In that year, he sold $5,800,000 of mobile homes and earned $61,000 before corporate tax. By 1968, he had joined the franchising movement and was selling others the right to sell mobile homes under his business name. He also conceived the bright idea of going into the business of preparing income tax returns using his mobile homes as offices. He formed a subsidiary called Mr. Tax of America and, of course, started to sell franchises to others to use the idea. And the name, he multiplied the number of corporate shares to 2,710,000 and was ready for a stock offering. He found that one of our largest stock exchange. Houses, along with others, was willing to handle the deal. In March 1969, they offered the public 500,000 shares of AAA Enterprises at $13 per share. Of these, 300,000 were sold from Mr. Williams per sole account, and 200,000 were sold for the company account, adding $2,400,000 to its resources. The price of the stock promptly doubled to 28, or a value of $84 million for the equity, against a book value of, say, $4,200,000 and maximum reported earnings of $690,000. The stock was thus selling at a tidy 115 times its current and largest earnings per share. No doubt Mr. Williams had selected the name AAA Enterprise so that it might be among the first in the phone books and the yellow pages. A collateral result was that his company was destined to appear as the first name in Standard & Poor's Stock Guide. Like Abu Benetham's, it led all the rest. This gives a special reason to select it as a harrowing example of 1969 new financing and hot issues. Comment: this was not a bad deal for Mr. Williams. The 300,000 shares he sold had a book value in December of 1968 of $180,000, and he netted there for 20 times as much, or a cool $3,600,000. The underwriters and distributors split $500,000 between them, less expenses. Went to jail. Even as you read this, another similar company is being formed, and a new generation of investors will be taken for a ride. No one who has read Graham, however, should climb on board. In Abu Benadham, by the British Romantic poet Leigh Hunt, 1784-1859, a righteous Muslim sees an angel writing in a golden book the names of those who love the Lord. When the angel tells Abu that his name is not among them, Abu says, "I pray thee then, write me as one that loves his fellow men." The angel returns the next night to show Abu the book, in which now Ben Adham's name led all the rest. 1. This did not seem so brilliant a deal for the clients of the selling houses. They were asked to pay about 10 times the book value of the stock, after the bootstrap operation of increasing their equity per share from 59 cents to $1.35 with their own money. Before the best year in 1968, the company's maximum earnings had been a ridiculous 7 cents per share. There were ambitious plans for the future, of course, but the public was being asked to pay heavily in advance for the hoped-for realization of these plans. 2. Nonetheless, the price of the stock doubled soon after original issuance, and any one of the brokerage house clients could have gotten out at a handsome profit. Did this fact alter the flotation, or did the advanced possibility that it might happen exonerate the original distributors of the issue from responsibility for this public offering and its later seek? Not an easy question to answer, but it deserves careful consideration by Wall Street and the government. Regulatory agencies .T subsequent history with its enlarged capital AAA enterprises went into additional businesses. In 1969, it opened a chain of retail carpet stores, and it acquired a plant that manufactured mobile homes. The results reported for the first 9 months were not exactly brilliant, but they were a little better than the year before 22 cents a share against 14 cents. What happened in the next months was literally incredible. The company lost $4,365,000 or $1.49 per share. This consumed Alit's capital before the financing plus the entire $2,400,000 received on sale of stock plus 2/3 of the amount reported as earned in the first 9 months of 1969. There was left a pathetic $242,000 or 8 cents per share of capital for the public shareholders who had paid $13 for the new offering only 7 months before. Nonetheless, the shares closed the year 1969 at 8% bid, or a valuation of more than $25 million. Lion for the company. Further comment 1. It is too much to believe that the company had actually earned $686,000 from January to September 1969. And then lost $4,365,000 in the next 3 months. There was something sadly, badly, and accusingly wrong about the September 30 report. 2. The year's closing price of 8% bid was even more of a demonstration of the complete heedlessness of stock market prices than were the original offering price of 13 or the subsequent hot issue advance to a high bid of 28. These latter quotations at least were based on enthusiasm and hope, out of all proportion to reality and common sense, but at least comprehensible. The year-end valuation of $25 million was given to a company that had lost all but a minuscule remnant of its capital, for which a completely insolvent condition was imminent, and for which the words enthusiasm or hope would be only bitter sarcasms. It is true the year-end figures had not been published by December 31st, but it is the business of Wall Street houses associated with the company to have monthly operating statements and a fairly exact idea of how things are going. Final chapter: for the first half of 1970, the company reported a further loss of $1 million. It now had a good-sized capital deficit. It was kept out of bankruptcy by loans made by Mr. Williams, up to a total of $2,500,000. No further statements seem to have been issued until in January 1971, AAA Enterprises finally filed a petition in bankruptcy. The quotation for the stock at month end was still 50 cents a share bid, or $1,500,000 for the entire issue, which evidently had no more than wallpaper value. End of our story. Moral and questions. The speculative public is incorrigible. In financial terms, it cannot count beyond 3. It will buy anything at any price if there seems to be some action in progress. It will fall for any company identified with franchising, computers, electronics, science, technology, or what have you when the particular fashion is raging. Our readers, sensible investors all, are of course above such foolishness. But questions remain. Should not responsible investment houses be honor-bound to refrain from identifying themselves with such enterprises? 9 out of 10 of which may be foredoomed to ultimate failure? This was actually the situation when the author entered Wall Street in 1914. By comparison, it would seem that the ethical standards of the street have fallen rather than advanced in the ensuing 57 years, despite all the reforms and all the controls. Could and should the SEC be given other powers to protect the public, beyond the present ones which are limited to requiring the printing of all important relevant facts in the offering prospectus? Should some kind of box score for public offerings of various types be compiled and published in conspicuous fashion? Should every prospectus, and perhaps every confirmation of sale under an original offering, carry some kind of formal warranty that the offering price for the issue is not substantially out of line with the ruling prices for issues of the same general type already established in the market? As we write this edition, a movement toward reform of Wall Street abuses is underway. It will be difficult to impose worthwhile changes in the field of new offerings, because the abuses are so. Largely the result of the public's own heedlessness and greed, but the matter deserves long and careful consideration. Commentary on Chapter 17. The wisdom god, Woden, went out to the king of the trolls, got him in an arm lock, and demanded to know of him how order might triumph over chaos. "Give me your left eye," said the troll, "and I'll tell you." Without hesitation, Woden gave up his left eye. "Now tell me." The troll said, "The secret is, watch with." Both eyes, John Gardner. The More Things Change. Graham highlights 4 extremes. An overpriced, tottering giant, an empire-building conglomerate. A merger in which a tiny firm took over a big one, an initial public offering of shares in a basically worthless company. The past few years have provided enough new cases of Graham's extremes to fill an encyclopedia. Here is a sampler. Lucent, not transparent. In mid-2000s, Lucent Technologies Inc. was owned by more investors than any other US stock. With a market capitalization of $192.9 billion, it was the 12th most valuable company in America. Was that giant valuation justified? Let's look at some basics from Lucent's financial report for the fiscal quarter ended June 30, 2001. A closer reading of Lucent's report sets alarm bells jangling like an unanswered telephone switchboard. Lucent had just bought an optical equipment supplier, Chromatis Networks, for $4.8 billion, of which $4.2 billion was goodwill, or cost above book value. Chromatis had 150 employees, no customers, and 0 revenues, so the term goodwill seems inadequate. Perhaps hope chest is more accurate. If Chromatis' embryonic products did not work out, Lucent would have to reverse the goodwill and charge it off against future earnings. A footnote discloses that Lucent had lent $1.5 billion to purchasers of its products. Lucent was also on the hook for $350 million in guarantees for money its customers had borrowed elsewhere. The total of these customer financings had doubled in a year, suggesting that purchasers were running out of cash to buy Lucent's products. What if they ran out of cash to pay their debts? Finally, Lucent treated the cost of developing new software as a capital asset. Rather than an asset, wasn't that a routine business expense that should come out of earnings? Conclusion. In August 2001, Lucent shut down. The Chromatis division after its products reportedly attracted only 2 customers out 2. In fiscal year 2001, Lucent lost $16.2 billion. In fiscal year 2002, it lost another $11.9 billion. Included in those losses were $3.5 billion. In provisions for bad debts and customer financings, $4.1 billion. In impairment charges related to goodwill and $362 million in charges related to capitalized software. Lucent's stock at $51.062 on June 30, 2000, finished 2002 at $1.26, a loss of nearly $190 billion in market value in 2.5 years. The acquisition magician. To describe Tyco International Limited, we can only paraphrase Winston Churchill and say that never has so much been sold by so many to so few. From 1997 through 2001, this Bermuda-based conglomerate spent a total of more than $37 billion, most of it in shares of Tyco stock, buying companies the way Imelda Marcos bought shoes. In fiscal year 2000s alone, according to its annual report, Tyco acquired approximately 200 companies, an average of more than one every other day. The result? Tyco grew phenomenally fast. In 5 years, revenues went from $7.6 billion to $34 billion. And operating income shot from a $476 million loss to a $6.2 billion gain. No wonder the company had a total stock market value of $114 billion at the end of 2001. But Tyco's financial statements were at least as mind-boggling as its growth. Nearly every year, they featured hundreds of millions of dollars in acquisition-related charges. These expenses fell into 3 main categories. 1. Merger or restructuring or other non-recurring costs. 2. Charges for the impairment of long-lived assets. And 3. Write-offs of purchase in-process research and development. For the sake of brevity, let's refer to the first kind of charge as moron, the second as chilla, and the third as whoopers. How? Did they show up over time? As you can see, the moron charges, which are supposed to be non-recurring, showed up in 4 out of 5 years and totaled a whopping $2.5 billion. Chilla cropped up just as chronically and amounted to more than $700 million. Whoopiprad came to another $500 million, the intelligent investor would ask. If Tyco's strategy of growth through acquisition was such a neat idea, how come it had to spend an average of $750 million a year, cleaning up after itself? If, as seems clear, Tyco was not in the business of making things but rather in the business of buying other companies that make things, then why were its moron charges non-recurring? Weren't they just part of Tyco's normal costs of doing business? And with accounting charges for past acquisitions junking up every year's earnings, who could tell what next year's would be? In fact, an investor couldn't even tell what Tyco's past earnings were. In 1999, after an accounting review by the U.S. Securities and Exchange Commission, Tyco retroactively added $257 million in moron charges to its 1998 expenses, meaning that those non-recurring costs that actually recurred in that year. AR2. At the same time, the company rejiggered its originally reported 1999 charges. Moron dropped to $929 million, while Chilla rose to $507 million. Tyco was clearly growing in size, but was it growing more profitable? No outsider could safely tell. Conclusion: in fiscal year 2002, Tyco lost $9.40 billion. The stock, which had closed at $58.90 at year-end 2001, finished 2002 at $17.08, a loss of 71% in 12. A minnow swallows a whale. On January 10, 2000s, America Online, Inc. and Time Warner, Inc. announced that they would merge in a deal initially valued at $156 billion. As of December 31st, 1999, AOL had $10.3 billion in assets, and its revenues over the previous 12 months had amounted to $5.7 billion. Time Warner, on the other hand, had $51.2 billion in assets and revenues of $27.3 billion. Time Warner was a vastly bigger company by any measure except one: the valuation of its stock. Because America Online bedazzled investors simply by being in the internet industry, its stock sold for a stupendous 164 times its earnings. Stock and Time. Warner, a grab bag of cable television, movies, music, and magazines, sold for around 50 times earnings. In announcing the deal, the two companies called it a strategic merger of equals. Time Warner's chairman, Gerald M. Levin, declared that the opportunities are limitless for everyone connected to AOL Time Warner, above all, he added, for its shareholders. Ecstatic that their stock might finally get the cachet of an internet. Darling, Time Warner shareholders overwhelmingly approved the deal, but they overlooked a few things. This merger of equals was designed to give America Online shareholders 55% of the combined company, even though Time Warner was 5 times bigger. For the second time in 3 years, the U.S. Securities and Exchange Commission was investigating whether America Online had improperly accounted for marketing costs. Nearly half of America Online's total assets, negative $4.9 billion worth, was made up of available-for-sale equity securities. If the prices of publicly traded technology stocks fell, that could wipe out much of the company's asset base. Conclusion: on January 11, 2001, the two firms finalized their merger. AOL Time Warner, Inc. lost $4.9 billion in 2001, and in the most gargantuan loss ever recorded by a corporation, another $98.7 billion in 2002. Most of the losses came from writing down the value of America Online. By year-end 2002, the shareholders for whom Levin predicted unlimited opportunities had nothing to show but a roughly 80% loss in the value of their shares since the deal was first announced. 5. Can you flunk invest in kindergarten? On May 20th, 1999, eToys Inc. sold 8% of its stock to the public. 4 of Wall Street's most prestigious investment banks, Goldman Sachs and Company, Bank Boston, Robertson Stevens, Donaldson, Lufkin and Jenrette, and Merrill Lynch and Company underwrote 320,000 shares at $20 apiece, raising $166.4 million. The stock roared up, closing at $76.562, a 282.8% gain in its first day of trading. At that price, eToys, with its 102 million shares, had a market value of $7.8 billion. www.lo.org. What kind of business did buyers get for that price? eToys sales had risen 4,261% in the previous year, and it had added 75,000 customers in the last quarter alone. But in its 20 months in business, eToys had produced total sales of $30.6 million, on which it had run a net loss of $30.8 million, meaning that eToys was spending $2 to sell every dollar's worth of toys. The IPO prospectus also disclosed that eToys would use some proceeds of the offering to acquire another online operation, Baby Center, Inc., which had lost $4.5 million on $4.8 million in sales over the previous year. To land this prize, eToys would pay a mere $205 million. And eToys would reserve 40.6 million shares of common stock for future issuance to its management. So, if eToys ever made money, its net income would have to be divided not among 102 million shares, but among 143 million, diluting any future earnings per share by nearly 1/3. A comparison of eToys with Toys R Us Inc., its biggest rival, is shocking. In the preceding 3 months, Toys R Us had earned $27 million in net income and had sold over 70 times more goods than eToys had sold in an entire year. And yet, as figure shows, the stock market valued eToys at nearly $2 billion more than Toys R Us. Conclusion: on March 7, 2001, eToys filed for bankruptcy protection after racking up net losses of more than $398 million in its brief life as a public company. The stock, which peaked at $86 per share in October 1999, last traded for a penny. Chapter 18, a comparison of 8 pairs of companies. Able F, the O, which, in E-million, and for more dear duting public, are a large company glomerati variety of. In this chapter we shall attempt a novel form of exposition by selecting 8 pairs of companies which appear next to each other, or nearly so, on the stock exchange list, we hope to bring home in a concrete and vivid manner some of the many varieties of character, financial structure, policies, performance, and vicissitudes of core, porate enterprises, and of the investment and speculative attitudes found on the financial scene in recent years. In each comparison, we shall comment only on those aspects that have a special meaning and import. Pair I, Real Estate Investment Trust, stores, offices, factories, etc., and Realty Equities Corp. Of New York, Real Estate Investment, General Construction. In this first comparison, we depart from the alphabetical order used for the other pairs. It has a special significance for us since it seems to encapsulate on the one hand all that has been reasonable, stable, and generally good in the traditional methods of handling other people's money, in contrast in the other company with the reckless expansion, the financial ledger domain, and the roller coaster changes so often found in present-day corporate operations. The two enterprises have similar names, and for many years they appeared side by side on the American Stock Exchange list. Their stock ticker symbols REI and REC could easily have been confused, but one of them is a staid New England trust, administered by 3 trustees, with operations dating back nearly a century, and with dividends paid continuously since 1889. It has kept throughout to the same type of prudent investments, limiting 1. April, Par 2, A. St. Maur, 209, 3, THR, Tota, 4, at Mo, Ba, Pa, 0, Ta, Appiing. Its expansion to a moderate rate and its debt to an easily manageable figure. The other is a typical New York-based sudden growth venture, which in 8 years blew up its assets from $6.2 million to $154 million. And its debts in the same proportion, which moved out from ordinary real estate operations to a miscellany of ventures, including 2 racetracks, 74 movie theaters, 3 literary agencies, a public relations firm, hotels, supermarkets, and a 26% interest in a large cosmetics firm, which went bankrupt in 1970. This conglomeration of business ventures was matched by a corresponding variety of corporate devices, including the following. 1. A preferred stock entitled to $7 annual dividends, but with a share. Par value of only $1 and carried as a liability at $1 per 2. A stated common stock value of $2,500,000, $1 per share. More than offset by a deduction of $5,500,000 as the cost of 209,000 shares of reacquired stock. 3. 3 series of stock option warrants giving rights to buy a total of 1,578,000 shares. 4. at least 6 different kinds of debt obligations in the form of mortgages, debentures, publicly held notes, notes payable to banks, notes, loans, and contracts payable, and loans payable to the Small Business Administration, adding up to over $100 million in March 1969. In addition, it had the usual taxes and accounts payable. Let us present first a few figures of the two enterprises as they appeared in 1960, Table 18-1A. Here we find the trust shares selling in the market for 9 times the aggregate value of equity stock. The trust enterprise had a smaller relative debt and a better ratio of net to gross, but the price of the common was higher in relation to per share earnings. Later, in Table 18-1B, we present the situation about 8 years the trust had kept the noiseless tenor of its way, increasing both its revenues and its per share earnings by about 3/4. But realty equities had been metamorphosed into something monstrous and vulnerable. How did Wall Street react to these diverse developments? By paying as little attention as possible to the trust and a lot to realty equities. In 1968, the latter shot up from 10 to 37% and the listed warrants from 6 to 36% on combined sales of 2,420,000 shares. While this was happening, the trust shares advanced sedately from 20 to 30% on modest volume. The March 1969 balance sheet of equities was to show an asset value of only $3.41 per share, less than a tenth of its high price that year. The book value off the trust shares was $20.85. The next year, it became clear that all was not well in the equities picture, and the price fell to 9%. When the report for March 1970 appeared, the shareholders must have felt shell-shocked as they read that the enterprise had sustained a net loss of $13,200,000, or $5.17 per share, virtually wiping out their former slim equity. This disastrous figure included a reserve of $8,800,000 for future losses on investments. Nonetheless, the directors had bravely declared an extra dividend of 5 cents right after the close of the fiscal year. But more trouble was in sight. The company's auditors refused to certify the financial statements for 1969 to 70, and the shares were suspended from trading on the American Stock Exchange. In the over-the-counter market, the bid price dropped below $2 per share. Real estate investment trust shares had typical price fluctuations after 1969. The low in 1970 was 16%, with a recovery to 26% in early 1971. The latest reported earnings were $1.50 per share, and the stock was selling moderately above its 1970 book value of $21.60. The issue may have been somewhat overpriced at its record high in 1968, but the shareholders have been honestly and well served by their trustees. The real estate equity story is a different and a sorry one. Pair 2, air products and chemicals, industrial and medical gases, etc., and air reduction company, industrial gases and equipment, chemicals. Even more than our first pair, these two resemble each other in both name and line of business. The comparison they invite is thus of the conventional type in security analysis, while most of our other pairs are more heteroclite in nature. Products is a newer Decor Auth, the RIA and QA, RIART, company than reduction, and in 1969 had less than half the others' volume. Nonetheless, its equity issue sold for 25% more in the aggregate than air reduction stock. As Table 18-2 shows, the reason can be found both in air reduction's greater profitability and in its stronger growth record. We find here the typical consequences of a better showing of quality. Air products sold at 160.12 times its latest earnings against only 9.1 times for air reduction. Also, air products sold well above its asset backing, while air reduction could be bought at only 75% of its book value. Air reduction paid a more liberal dividend, but this may be deemed to reflect the greater desirability for air products to retain its earnings. Also, air reduction had a more comfortable working capital position. On this point, we may remark that a profitable company can always put its current position in shape by some form of permanent financing, but by our standards, air products was somewhat overbonded. If the analyst were called on to choose between the two companies, he would have no difficulty in concluding that the prospects of air products look more promising than those of air reduction. But did this make air products more attractive at its considerably higher relative price? We doubt whether this question can be answered in a definitive fashion. In general, Wall Street sets quality above quantity in its thinking, and probably the majority of security analysts would opt for the better but dearer air prod against the poorer but cheaper air reduction, weather. This preference is to prove right or wrong is more likely to depend on the unpredictable future than on any demonstrable investment principle. In this instance, air reduction appears to belong to the group of important companies in the low multiplier class. If, as the studies referred to above it would seem to indicate, that group ASA. UCT says w.lo.org.whole is likely to give a better account of itself than the high multiplier stocks. Then air reduction should logically be given the preference, but only as part of a diversified operation. Also, a thoroughgoing study of the individual companies could lead the analyst to the opposite conclusion, but that would have to be for reasons beyond those already reflected in the past showing. Sequel, air products stood up better than air reduction in the 1970 break with a decline of 16% against 24%. However, reduction made a better comeback in early 1971, rising to 50% above its 1969 close, against 30% for products. In this case, the low multiplier issue scored the advantage for the time being at least. Pair 3, American Home Products Company, drugs, cosmetics, household products, candy. An American Hospital Supply Company, distributor and manufacturer of hospital supplies and equipment. These were $2 billion goodwill companies at the end of 1969, representing different segments of the rapidly growing and immensely profitable health industry. We shall refer to them as home and hospital, respectively. Selected data on both are presented in Table 18-3. They had the following favorable points in common. Excellent growth, with no setbacks since 1958, i.e., 100% earning stability, and strong financial condition. The growth rate of hospital up to the end of 1969 was considerably higher than home's. On the other hand, home enjoyed substantially better profitability on both sales and capital. In fact, the relatively low rate of hospital's earnings on its capital in 1969, only 9.7%, raises the intriguing question whether the business then was in fact a highly profitable one, despite its remarkable past growth rate in sales and earnings. When comparative price is taken into account, home offered much more for the money in terms of current or past earnings and dividends. The very low book value of home illustrates a basic ambiguity or contradiction in common. Stock analysis, on the one hand, it means that the company is earning a high return on its capital, which in general is a sign of strength and prosperity. On the other means that the investor at the current price would be especially vulnerable to any important adverse change in the company's earnings situation, since hospital was selling at over 4 times its book value in 1969. This cautionary remark must be applied to both companies. Conclusions. Our clear-cut view would be that both companies were too rich at their current prices to be considered by the investor who decides to follow our ideas of conservative selection. This does not mean that the companies were lacking in promise. The trouble is rather that their price contained too much promise and not enough actual performance. For the two enterprises combined, the 1969 price reflected almost $5 billion of goodwill valuation. How many years of excellent future earnings would it take to realize that goodwill factor in the form of dividends or tangible assets? Short-term sequel. At the end of 1969, the market evidently thought more highly of the earnings prospects of hospital than of home, since it gave the former almost twice the multiplier of the latter. As it happened, the favored issue showed a microscopic decline in earnings in 1970, while home turned in a respectable 8% gain. The market price of hospital reacted significantly to this one-year disappointment. It sold at 32 in February 1971, a loss of about 30% from its 1969 close, while home was quoted slightly above its corresponding level. Pair 4, H&R Block, Inc., Income Tax Service, and Bluebell, Inc., manufacturers of work clothes, uniforms, etc. These companies rub shoulders as relative newcomers to the New York Stock Exchange, where they represent two very different genres of success stories. Bluebell came up the hard way in a highly competitive industry, in which eventually it became the largest factor. Its earnings have fluctuated somewhat with industry conditions, but their growth since 1965 has been impressive. The company's operations go back to 1916 and its continuous dividend record to 1923. At the end of 1969, the stock market showed no enthusiasm for the issue, giving it a price-earnings ratio of only 11%, against about 17% for the S&P Composite Index. By contrast, the rise of H&R Block has been meteoric. Its first, Table. Published figures date only to 1961, in which year it earned $83,000 on revenues of $610,000. But 8 years later, on our comparison date, its revenues had soared to $53.6 million and its net to $6.3 million. At that time, the stock market's attitude toward this fine performer appeared nothing less than ecstatic. The price of 55 at the close of 1969 was more than 100 times the last reported 12 months earnings, which of course were the largest to date. The aggregate market value of $300 million for the stock issue was nearly 30 times the tangible assets behind the shares. This was almost unheard of in the annals of serious stock market valuations. At that time, IBM was selling at about 9 times and Xerox at 11 times book value. Our table 18-4 sets forth in dollar figures and in ratios the extraordinary discrepancy in the comparative valuations of Block and Blue Bell. True, Block showed twice the profitability of Blue Bell per dollar of capital, and its percentage growth in earnings over the past 5 years, from practically nothing, was much higher. But as a stock enterprise, Blue Bell was selling for less than 1/3 the total value of Block, although Blue Bell was doing 4 times as much business, earning 21.2 times as much for its stock, had 51.2 times as much intangible investment, and gave 9 times the dividend yield on the price. Indicated conclusions: an experienced analyst would have conceded great momentum to Block, implying excellent prospects for future growth. He might have had some qualms about the dangers of serious competition in the income tax service field. Lured by the handsome return on capital realized by Block, but mindful of the continued success of such outstanding companies as Avon Products in highly competitive areas, he would have hesitated to a speedy flattening out of the Block growth curve. His chief, predict, price, num, mark, debt, total book sales, net, in, earn, cursive, rat, pp. Concern would be simply whether the $300 million valuation for the company had not already fully valued and perhaps overvalued all that one could reasonably expect from this excellent business. By contrast, the analyst should have had little difficulty in recommending Blue Bell as a fine company, quite conservatively priced. Sequel to March 1971. The 1970 near panic lopped 1/4 off the price of Blue Bell and about 1/3 from that of Block. Both then joined in the extraordinary recovery of the General Mar. www.lo.org.ket. The price of Block rose to in February, but Blue Bell advanced considerably more to the equivalent of 109 after a 3-for-2 split. Clearly, Blue Bell proved a better buy than Block as of the end of 1969. But the fact that Block was able to advance some 35% from that apparently inflated value indicates how wary analysts and investors must be to sell good companies short either by word or deed, no matter how high the quotation may seem. Pair 5. International flavors and fragrances, flavors, etc. for other businesses. An international harvester company, truck manufacturer, farm machinery, construction machinery. This comparison should carry more than one surprise. Everyone knows of International Harvester, one of the 30 giants in the Dow Jones Industrial Average. How many of our readers have even heard of International Flavors and Fragrances? Next door neighbor, too. Harvester on the New York Stock Exchange list? Yet, Mara Benedictu, IF was actually selling at the end of 1969 for a higher aggregate market value than Harvester, $747 million versus $710 million. This is the more amazing when one reflects that Harvester had 17 times the stock capital of Flavors and 27 times the annual sales. In fact, only 3 years before, the net earnings of Harvester had been larger than the 1969 sales of Flavors. How did these extraordinary disparities develop? The answer lies in the 2 magic words, profitability and growth. Flavors made a remarkable showing in both categories, while Harvester left everything to be desired. The story is told in Table 18-5. Here we find Flavors with a sensational profit of 14.3% of sales before income tax. The figure was, compared with a mere 2.6% for Harvester. Similarly, Flavors had earned 19.7% on its stock capital against an inadequate 5.5% earned by Harvester. In 5 years, the net earnings of Flavors had nearly doubled, while those of Harvester practically stood still. Between 1969 and 1959, the comparison makes similar reading. These differences in performance produced a typical stock market divergence in valuation. Flavors sold in 1969 at 55 times its last reported earnings, and Harvester at only 10.7 times. Correspondingly, Flavors was valued at 10.4 times its book value, while Harvester was selling at a 41% discount from its net worth. Comment and conclusions. The first thing to remark is that the market success of Flavors was based entirely on the development of its central business and involved none of the corporate wheeling and dealing, acquisition programs, top-heavy capitalization structures, and other familiar Wall Street practices of recent years. The company has stuck to its extremely profitable knitting, and that is virtually its whole story. The record of Harvester raises an entirely different set of questions, but these two have nothing to do with high finance. Why have so many great companies become relatively unprofitable even during many years of general prosperity? What is the advantage of doing more than $2 billion of business if the enterprise cannot earn enough to justify the shareholders' investment? It is not for us to prescribe a solution of this problem, but we insist that not only management but the rank and file of shareholders should be conscious that the problem exists and that it calls for the best brains and the best efforts possible to deal with it. From the standpoint of common stock selection, neither issue would have met our standards of sound, reasonably attractive, and moderately priced investment. Flavors was a typical brilliantly successful but lavishly valued company. Harvester's showing was too mediocre to make it really attractive, even at its discount price. Undoubtedly, there were better values available in the reasonably priced class. Sequel to 1971, the low price of Harvester at the end of 1969, protected it from a large further decline in the bad break of 1970. It lost only 10% more. Flavors proved more vulnerable and declined to 45, a loss of 30%. In the subsequent recovery, both advanced well above their 1969 close, but Harvester soon fell back to the 25 level. Pair 6, McGraw-Edison, Public Utility and Equipment, Housewares, McGraw-Hill Inc., Books, Films, Instruction Systems, Magazine and Newspaper Publishers, Information, Services. This pair with so similar names, which at times we shall call Edison and Hill, are two large and successful enterprises in vastly different fields. We have chosen December 31st, 1968 as the date of our comparison, developed in Table 18-6. The issues were selling at about the same price, but because of Hill's larger capitalization, it was valued at about twice the total figure of the other. This difference should appear somewhat surprising, since Edison had about 50% higher sales and 1/4 larger net earnings. As a result, we find that the key ratio, the multiplier of earnings, was more than twice as great for Hill as for Edison. This phenomenon seems explicable chiefly by the persistence of a strong enthusiasm and partiality exhibited by the market towards shares of book publishing companies, several of which have been introduced to public trading in the later 1960s. Actually, by the end of 1968, it was evident that this enthusiasm had been overdone. The Hill shares had sold at 56 in 1967, more than 40 times the just reported record earnings for 1966. But a small decline had appeared in 1967 and a further decline in 1968. Thus, the current high multiplier of 35 was being applied to a company that had already shown 2 years of receding profits. Nonetheless, the stock was still valued at more than 8 times its tangible asset backing, indicating a goodwill component of not far from $1 billion. Thus, the price seemed to illustrate, in Dr. Johnson's famous phrase, the triumph of hope over experience. By contrast, McGraw-Edison seemed quoted at a reasonable price in relation to the high general market level and to the company's overall performance and financial position. Sequel to early 1971, the decline of McGraw-Hill's earnings continued through 1969 and 1970, dropping to $1.02 and then to 82 per share. In the May 1970 debacle, its price suffered a devastating break to 10% less than a fifth of the figure 2 years before. It had a good recovery thereafter, but the high of 24 in May 1971 was still only 60% of the 1968 closing price. McGraw-Edison gave a better account of itself, declining to 22 in 1970 and recovering fully to 41% in May 1971. McGraw-Hill continues to be a strong and prosperous company, but its price history exemplifies, as do so many other cases, the speculative hazards in such stocks created by Wall Street through its undisciplined waves of optimism and pessimism. Pair 7, National General Corp., a large conglomerate, and National Presto Industries, diverse electric appliances ordnance. These two companies invite comparison chiefly because they are so different. Let us call them General and Presto. We have selected the end of 1968 for our study because the write-offs taken by General in 1969 made the figures for that year too ambiguous. The full flavor of General's far-flung activities could not be savored the year before, but it was already conglomerate enough for anyone's taste. The condensed description in the stock guide read, nationwide theater chain, motion picture and TV production, savings and loan asset, book publishing, to which could be added, then or later, insurance, investment banking, records, music publishing, computerized services, real estate, and 35% of Performance Systems, Inc., name recently changed from Mini Pearl's Chicken System, Inc. Presto had also followed a diversification program, but in comparison with General, it was modest indeed. Starting as the leading maker of pressure cookers, it had branched out into various other household and electric appliances. Quite differently, also, it took on a number of ordnance contracts for the U.S. government. Our table 18-7 summarizes the showing of the companies at the end of 1968. The capital structure of Presto was as simple as it could be, nothing but 1,478,000 shares of common stock selling in the market for $58 million. Contrastingly, General had more than twice as many shares of common, plus an issue of convertible preferred, plus 3 issues of stock warrants calling for a huge amount of common, plus a towering convertible bond issue just given in exchange for stock of an insurance company, plus a goodly sum of non-convertible bonds. All this added up to a market capitalization of $534 million, not counting an impending issue of convertible bonds, and $750 million, including such issue. Despite National General's enormously greater capitalization, it had done considerably less gross business than Presto in their fiscal years, and it had shown only 75% of Presto's net income. The determination of the true market value of General's common stock capitalization presents an interesting problem for security analysts and has important implications for anyone interested in the stock on any basis more serious than outright gambling. The relatively small 41-2 convertible preferred can be readily taken care of by assuming its conversion into common when the latter sells at a suitable market level. This we have done in table 18-7, but the warrants require different treatment. In calculating the full dilution basis, the company assumes exercise of all the warrants and the application of the proceeds to the retirement of debt, plus use of the balance to buying common at the market. These assumptions actually produced virtually no effect on the earnings per share in calendar 1968, which were reported as $1.51, both before and after allowance for dilution. We consider this treatment illogical and unrealistic. As we see it, the warrants represent a part of the common stock package, and their market value is part of the effective market value of the common stock part of the capital. See our discussion of this point on P415 above. This simple technique of adding the market price of the warrants to that of the common has a radical effect on the showing of National General at the end of 1968, as appears from the calculation in table 18-7. In fact, the true market price of the common stock turns out to be more than twice the quoted figure. Hence, the true multiplier of the 1968 earnings more than doubled to the inherently absurd figure of 69 times. The total market value of the common stock equivalents then becomes $413 million, which is over 3 times the tangible assets shown. Therefore, these figures appear the more anomalous when comparison is made with those of Presto. One is moved to ask, how could Presto possibly be valued at only 6.9 times its current earnings when the multiplier for General was nearly 10 times as great? All the ratios of Presto are quite satisfactory, the growth figure suspiciously so, in fact. By that we mean that the company was undoubtedly benefiting considerably from its war work, and the shareholders should be prepared for some falling off in profits under peacetime conditions. But, on balance, Presto met all the requirements of a sound and reasonably priced investment, while General had all the earmarks of a typical conglomerate of the late 1960s vintage, full of corporate gadgets and grandiose gestures, but lacking in substantial values behind the market quotations. Sequel. General continued its diversification policy in 1969 with some increase in its debt, but it took a whopping write-off of millions, chiefly in the value of its investment in the Mini Pearl chicken deal. The final figure showed a loss of $72 million before tax credit and $46.4 million after tax credit. The price of the shares fell to 16% in 1969 and as low as 9% in 1970, only 15% of its 1968 high of 60. Earnings for 1970 were reported as $2.33 per share diluted, and the price recovered to 28% in 1971. National Presto increased its per-share earnings somewhat in both 1969 and 1970, marking 10 years of uninterrupted growth of profits. Nonetheless, its price declined to 21% in the 1970 debacle. This was an interesting figure, since it was less than 4 times the last reported earnings, and less than the net current assets available for the stock at the time. Late 1971, we find the price of National Presto 60% higher, at 34, but the ratios are still startling. The enlarged working capital is still about equal to the current price, which in turn is only 512 times the last reported earnings. If the investor could now find 10 such issues for diversification, he could be confident of satisfactory results. Assets for the common sold at about 4 times the aggregate value of the other. The higher valued company was about to report a large loss after special charges. It had not paid a dividend in 13 years. The other had a long record of satisfactory earnings, had paid continuous dividends since 1936, and was currently returning one of the highest dividend yields in the entire common stock list. To indicate more vividly the disparity in the performance of the two companies we append, in Table 18.8b, the earnings and price record for 1961 to 1970. The history of the two companies throws an interesting light on the development of medium-sized businesses in this country, in contrast with much larger-sized companies that have mainly appeared in these pages. Whiting was incorporated in 1896, and thus goes back at least 75 years. It seems to have kept pretty faithfully to its materials handling business and has done quite well with it over the decades. Wilcox and Gibbs goes back even farther to 1866, and was long known in its industry as a prominent maker of industrial sewing machines. During the past decade, it adopted a policy of diversification in what seems a rather outlandish form. For on the one hand, it has an extraordinarily large number of subsidiary companies, at least 24, making an astonishing variety of products. But on the other hand, the entire conglomeration adds up to mighty small potatoes by usual Wall Street standards. The earnings developments in Whiting are rather characteristic of our business concerns. The figures show steady and rather spectacular growth from 41 cents a share in 1960 to $3.63 in 1968. But they carried no assurance that such growth must continue indefinitely. The subsequent decline to only $1.77 for the 12 months ended January 1971 may have reflected nothing more than the slowing down of the general economy. But the stock price reacted in severe fashion, falling about 60% from its 1968 high, 43%, to the close of 1969. Our analysis would indicate that the shares represented a sound and attractive secondary issue investment suitable for the enterprising investor as part of a group of such commitments. Sequel. Wilcox and Gibbs showed a small operating loss for 1970. Its price declined drastically to a low of 41.2, recovering in typical fashion to 91.2 in February 1971. It would be hard to justify that price statistically. Whiting had a relatively small decline to 16% in 1970. At that price, it was selling at just about the current assets alone available for the shares. Its earnings held at $1.85 per share to July 1971. In early 1971, the price advanced to $241.2, which seemed reasonable enough but no longer a bargain by our standards. General observations. The issues used in these comparisons were selected with some malice aforethought, and thus they cannot be said to present a random cross-section of the common stock list. Also, they are limited to the industrial section and the important areas of public utilities. YM, transportation companies, and financial enterprises do not appear. But they vary sufficiently in size, lines of business, and qualitative and quantitative aspects to convey a fair idea of the choices confronting an investor in common stocks. The relationship between price and indicated value has also differed greatly from one case to another. For the most part, the companies with better growth records and higher profitability have sold at higher multipliers of current earnings, which is logical enough in general. Whether the specific differentials in price-earnings ratios are justified by the facts or will be vindicated by future developments cannot be answered with confidence. On the other hand, We do have quite a few instances here in which a worthwhile judgment can be reached. These include virtually all the cases where there has been great market activity in companies of questionable underlying soundness. Such stocks not only were speculative, which means inherently risky, but a good deal of the time they were and are obviously overvalued. Other issues appeared to be worth more than their price, being affected by the opposite sort of market attitude, which we might call under-speculation, or by undue pessimism because of a shrinkage in earnings. In Table 18-9, we provide some data on the price fluctuations of the issues covered in this chapter. Most of them had large declines between 1961 and 1962, as well as from 1969 to 1970. Clearly, the investor must be prepared for this type of adverse market movement in future stock markets. In Table 18-10, we show year-to-year fluctuations of McGraw-Hill common stock for the period 1958 to 1970. It will be noted that in each of the last 13 years, the price either advanced or declined over a range of at least 3 to 2% from one year to the next. In the case of National General, fluctuations of at least this amplitude, both upward and downward, were shown in each 2-year period. In studying the stock list for the material in this chapter, we were impressed once again by the wide difference between the usual objectives of security analysis and those we deem dependable and rewarding. Most security analysts try to select the issues that will give the best account of themselves in the future, in terms chiefly of market action, but considering also the development of earnings. We are frankly skeptical as to whether this can be done with satisfactory results. Our preference for the analyst's work would be rather that he should seek the exceptional or minority cases in which he can form a reasonably confident judgment that the price is well below value. He should be able to do this work with sufficient expertness to produce satisfactory average results over the years.